you're a Fed who cares about inflation or cares about unemployment, the right thing to do is to address inflation head on.
For now, they're very much still steering towards higher interest rates and higher inflation. So I don't think they're going to pause.
The economy's been stronger than I think that people realize.
We do think that the market is over expecting a Fed pivot in the near term. I can't see how that happens.
I don't think the pivot will occur as soon as some people are hoping for.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is GDP Day, live from New York City.
Listen to you.
For our audience worldwide. I knew you'd like that. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Bramo said I need to straighten my tie, Tom. Seconds before we came live.
Yeah,
You didn't say that. You were asking, and I said, maybe
Sorted
right over here.
Okay.
You look great.
Thank you. Let's
So
get
do
it
you,
together.
Tom.
Futures down 1/3 of 1%. Why are you buttering us up? On the Nasdaq 100, we're down about 3/4 of 1%. TK GDP coming out a little bit later.
GDP coming out, to me, it's really, really important. It's always underplayed by the media, John. We look at one statistic. You know what? It's hundreds of data points as a first look, second look, third look. John, you put out on Twitter the huge dispersion on Wall Street. Really remarkable.
I have to say, the recent forecasts, the updated ones, they lean a little bit more optimistic, constructive after the data.
Well, yes, after inventories as well. John, I got to cover the surveillance pivot right now. The surveillance pivot is very important. It's far more important than the Fed pivot. The surveillance pivot is we promise folks to try to get 6 hours sleep here as we
a little bit later. Isn't that the big pivot? What do you make of the Fed pivot? Can we even call it that? Some people are saying we saw the first signs of it.
This is really important, ending with Michael McKee's non-answer to Michael McKee's good question. Colby Smith of the FT asked sort of a convoluted question. She got it out. I don't know what was wrong with her, but she moved the market with his answer, John, and that was where we were off to the races. And what was it about? It's about forward guidance. It's gone. And I'm sorry, John, even for the sophisticates, that's a new idea.
Sure. So you leave space for a forward guidance-free, data-dependent stance. And what did the market do? Rushed in, Lisa, with some kind of dovish interpretation of what was going on.
So I was searching for some sort of explanation other than the market is just wrong, because that was my knee-jerk reaction, and basically saying, I don't really see where they're gaining their enthusiasm just from a lack of knowledge. Some of the analyst notes were pointing to this belief that Fed Chair Jay Powell has, a controversial belief that we're getting closer to neutral. That was something Bill Dudley pushed back against. Also, this belief that there is a risk of going too far in addition to not going far enough, a recognition of the pain that a vulgarized Fed could possibly cause. So these are some of the reasons people are giving. I don't know if I buy it, though, because how could you get a knee-jerk rally that was the biggest in the Nasdaq going back to November of 2020 on the heels of this?
Here's a tough one. If Chairman Powell had what we had in front of him in that news conference, which is a list of stock market indices in front of us here, how do you think he'd respond to that? Do you think that's the outcome he wanted to see?
So Bill Dudley was saying that basically if the market rallies 5 to 10%, and I assume he was talking about the S&P, not the Nasdaq, that would actually go against what the Fed is trying to do. Some people could say this goes against what he's hoping for. Others would push back and say there's already been so much bad news priced in, and the rally is actually a sign of optimism that perhaps we've priced a lot of this in.
John is looking at AC Milan's futures here and what the friendlies are going to be for AC Milan. I'm actually doing technical analysis while Mr. Powell was going on. And John, unequivocally looking at what's called a point and figure chart of the Standard & Poor's 500, we really haven't had a bear market breakout. It was a big pop yesterday. And today, with the tech earnings, is a big now what Thursday.
I'm just so pleased one of us is doing the work, Tom.
It's good.
And that person is you.
Yeah.
Futures on the S&P, negative 1/3 of 1% on the S&P this morning. We declined on the Nasdaq 100, down 0.7 of 1%. To TK's point, a little bit later, we're going to have some big earnings from Apple, from Amazon. Bramo's going to go through the data points, the earnings you need to watch for the day ahead. Yields unchanged, Lisa, 277.94 on a 10-year this morning.
Okay, so here's what we're looking at. It might be GDP Thursday because we are getting that initial read on the second quarter GDP for the United States. People wondering whether this is a technical recession. That has been allayed given some of the data that we saw yesterday. That comes out at 8:30. I actually am more interested in initial jobless claims. The GDP print is backward looking. The jobless claims is a more real-time version of the labor market that seems to be the data point that Fed Chair Jay Powell was pointing to yesterday. Yes, weakening data. However, jobs remain very strong and in full supply. At what point does that dual mandate, John, as you put it yesterday, become more in a conflict in terms of fighting inflation and supporting the labor market? Today, a slew of policy discussions, including a really important call between President Joe Biden and Xi Jinping of China. We don't know exactly when that will be, but reportedly they will be speaking about a number of issues, including tariffs. Will the U.S. remove some of the tariffs from the Trump era on Chinese goods? And of course, Janet Yellen will also be speaking at 1:30 p.m. on the economy. How does she spin some of the data that we got earlier today, as well as the Fed's reaction to it? And after the bell, just to give you some perspective, about half of companies in the S&P have reported second quarter earnings so far. After the bell, Intel, Apple, and Amazon are among a slew of companies reporting earnings that account for nearly 20% of the S&P. How much do we get a sense, particularly with Apple, of what the consumer demand is like for electronic goods? Because, John, we have seen an increasing amount of softening. There has been resilience in the likes of Google, resilience in the likes of Microsoft. Do we see that continue for Apple?
Those two names, Apple and Amazon, about 20% of the Nasdaq 100. Just those two names.
Yeah.
Lisa, Tom Keene, some big earnings coming up a little bit later.
They are, and it is about China. And I agree with the different punditry I'm seeing across the Bloomberg terminal that Apple's a huge mystery. And as Julian Emanuel and his team say at Evercore ISI, they're really going to focus on the conference calls of Apple and the guidance forward, because it's, as Alarian would say, it's an unknown right now.
Let's get some guidance forward. We can do that with Eric Friedman, the Chief Investment Officer at US Bank Asset Management. Eric, you have been more conservative, somewhat bearish on global equities. Did that change yesterday?
It didn't, Jonathan. I think that getting back to the technical comment, for us, our proverbial bear costume would get a little bit itchy at around 4,200 in the S&P. I do think that there was a pivot. It was that meeting-to-meeting guidance forward viewpoint from Chair Powell. And so what I think that means for us as professional investors and our peers is just how strong is your conviction about higher prices remaining sticky? And I think the second thing is how convinced are we that the liquidity picture dries up? And so those are the two variables that we still think are concerning, still leave us with more of a bearish tilt. But again, that meeting-to-meeting guidance requires our models to be that much sharper, given where we are from forward guidance versus meeting-to-meeting guidance.
Eric Friedman, is your team noting that corporations are adapting? I mean, it's the oddest time that we're in right now. We certainly noticed that with Chairman Powell. Are corporations adapting and adjusting to this new post-COVID landscape?
Tom, I think that's a really important observation. And I think that we in the financial community steal a lot of things from other industries. And that concept of homeostasis, or basically the adjustments that companies and consumers and governments make in a system like an economy, is very much intact right now. And I think that the center stage for that, and really ties into your earlier comments about GDP, are what's happening in inventories. You've heard that from both big box retailers as well as e-tailers, that it's been a difficult exchange between information from consumers and obviously suppliers about what they should be stocking their shelves with. So we think that this adjustment process from stocking goods, as well as the experiential travel variables we're, of course, paying attention to right now, that we think is going to take a couple quarters to sort out. The consumer is a moving target. And again, it speaks to that notion of that homeostasis, that readjustment that's happening in real time.
So, Eric, you still think that there is some pessimism that hasn't been baked in, certainly to risk assets. But what do you then do with your investments? Because bonds have also rallied at a time when the Fed is basically saying we're going to do what it takes to get inflation down. At a certain point, do you just hide in cash and wait for that clarity?
Yeah, Lisa, we've been really of the mindset that there's not going to be that proverbial Minsky moment where we just see credit spreads blow out and equities fall asunder. But we do think that there is going to be probably a drip lower in earnings especially. And so I think that while this earnings season is important, next earnings season is more important. So our viewpoint has been, let's add a little more to infrastructure, add a little bit more to real assets, not necessarily taking a bet on oil and hydrocarbon beta, but really paying more attention to the reopening trade that's happening very gradually. So that's been one thing that we've been emphasizing in portfolios. From a duration perspective, we've really been leaning more towards shorter duration, just with a viewpoint that we have to see, again, how this forward guidance shakes out. We're actually getting a little more interested in buying duration here. But again, our viewpoint is that the rotation back into, let's call it, lower quality equities, Europe is really something that we're going to wait for probably for another quarter. So really more taking benchmark relative risk in terms of shorter duration, as well as a little less equity exposure, more infrastructure is the way we're thinking about things right now.
A wait and see stance. Eric, thank you. Eric Friedman there of US Bank Asset Management. Lisa, this is what the big bulls, Marko Kolanovic of JP Morgan, have been waiting for. They think this is evidence potentially of peak Fed hawkishness. It's behind us and you can buy this market again.
When was the last time that we said that?
I mean, the last meeting.
Exactly.
I
mean,
off.
At what point? I mean, peak hawkishness for them saying we're now going meeting to meeting. Is that basically a bet that CPI, that headline consumer inflation is going to come down pretty dramatically, and that the Fed is going to face a dramatically weakening economic outlook at a time when a number of the statistics have been beating, when companies are still actually doing better than many expected? How do they parse through this and get to a place where a Fed is going to fight inflation, get it down to 2%, and still manage not to raise rates much further than where they are right now?
It's both, if that helps. Clearly, the bet is on the data. Right. And we're going to be so sensitive to the incoming data, Tom, over the next few months, going into that September meeting.
You know, I'm a sensitive guy. What I would note, John, in terms of the data is the compendium of it with the inflation-adjusted yield. I'm going to extrapolate it out here on the break, but John, are you ready for a negative real yield? I'm eyeballing it right now in late October for Halloween as a trick-or-treat, a new negative real yield.
How are you expecting me to take that seriously, that you're a sensitive guy?
I'm a sensitive guy.
Come on.
You know.
Bramo is TK a sensitive guy.
They're forcing me to take tomorrow
Lisa's
off.
not even speaking.
He's
right
very
now.
sensitive to Louis Vuitton.
What did you call it,
What
Tom?
did you call it? I'm trying to think.
Vuitton.
You know, it's great.
Vuitton. Vuitton.
And I guess they're doing well. I mean, they're bustling over at 57. I didn't go to 56, but I got to 57th Street.
I tell you who's not doing well.
John, they're forcing me to take
Meta.
off tomorrow. It's un-American.
Facebook's down. Tom's taking a day off.
I'm on halls.
You're on halls for how long?
One day.
Long weekend. So American of you. Futures down a third of 1%. Yeah. Is that it for the summer?
That's it for the summer. Reading.
A long weekend. Tom's summer vacation. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a deal that breaks a long deadlock on major parts of President Joe Biden's economic agenda. Democratic Senator Joe Manchin and Senate Majority Leader Chuck Schumer have agreed on a tax, energy and climate bill. It calls for a 15% corporate minimum tax and would allow Medicare to negotiate drug price cuts. But Manchin blocked expanding the state and local tax deduction known as SALT. Now, Fed Chair Jerome Powell is signaling that more rate hikes are coming. Powell spoke after policymakers raised the benchmark lending rate by 75 basis points. He said the Fed will press on with the steepest tightening in a generation to curb inflation. At the same time, Powell stepped away from the exact guidance he gave at the June meeting. U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart about a deal to free imprisoned basketball star Brittany Griner and another jailed American. Bloomberg has learned the U.S. would swap them for a Russian arms dealer it holds. Griner did plead guilty this month to smuggling cannabis oil in a vape cartridge. According to a Russian media report, Moscow says there is no agreement yet. Billionaire Jack Ma reportedly will relinquish control of Ant Group, according to the Wall Street Journal. That's part of the fintech company's effort to move away from Alibaba, the e-commerce giant that Ma co-founded. Ant was forced to recognize under pressure from the Chinese government. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
as it relates to September. I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see. And we're going to be making decisions meeting by meeting.
It's such a long road to September. Chairman Powell of the Federal Reserve, we've got so much data to get through, and I imagine the view on the Fed in September is going to change about 50,000 times over the next 2 months or so. From New York City this morning, good morning, Tom Keene, Lisa Abramowicz and Jonathan Ferro. Your market looks like this, negative 1/3% on the S&P, on the Nasdaq 100. Yesterday, up by more than 4%, the biggest one-day pop going back to November 2020. Today, we're down about 0.75%. Yields basically unchanged, TK, 278.12 on a 10-year. The euro showing some weakness. Euro dollar negative 0.4%, 101.57.
VIX 23.31 after the festivities of yesterday. Right now on your legislation in Washington, we welcome Jack Fitzpatrick after a sleepless night with Bloomberg at government. Jack, my math is 400 billion off of a $2 trillion list. So I guess 22% of a $2 trillion Build Back Better. Was it that big of a haircut?
Yeah, they shrunk down the list of Democratic priorities really significantly. And even if you look at the revenue raisers compared to what they originally talked about, you know,
right.
they have a deal now for a 15% corporate minimum rate. They're not changing the corporate tax rate. They're not touching the income tax. Overall, it's much, much smaller. There's no child tax credit extension. They tried that, and it really didn't have the traction that they wanted. So people like Bernie Sanders, who had a big say in the early development of their ideas list, are going to be let down by this. But this is what they realistically can get through the Senate, through the reconciliation process, is what they can get the moderates on board with.
Well, I want to get Jack, I want to get ahead past the Sunday programs and maybe past the first Tuesday of November. If I read that, you know, the what's happened in the last 24 hours, is there a left in the Democratic Party? It sounds like a colossal defeat for the so-called progressives.
I think the defeat was already there. If not for this bill, there was going to be essentially nothing. They were talking about just doing a prescription drug price measure, and that's it. They had already winnowed away at the big priorities. Again, is something like the child tax credit, which was something a lot of progressives pushed for years, and they got through the stimulus. They made it law briefly. It expired, and they just didn't have the political wherewithal to extend that kind of thing. It was clear that, you know, when you heard Bernie Sanders talking about his priority list was about $6 trillion, that was not going to happen. It wasn't going to be anything close to the original proposals. They had their chance, and Biden worked with them to allow them to be the ones putting out the proposals originally, but they couldn't get people like Manchin on board. And so the weight of the Democratic Party has shifted very significantly toward people like Joe Manchin.
Well, there's also been a complete shift in the branding of this, right? It was Build Back Better originally. Now, instead of being Energy Climate Tax Plan, it's called the Inflation Reduction Act of 2022. There has been legislation with this and also the chip semiconductor bill that was passed just recently this week as well. How much does this actually serve as a game changer heading into the midterms?
I think you are right to touch on the branding of this and the fact that they needed to emphasize that this bill probably is, there's nothing in there that it really kicks inflation. It has stuff that has a disinflationary effect. It would reduce the deficit a bit. That speaks to the fact that Democrats felt the need to make a point that they were trying to do something. It's not as if this bill or the CHIPS bill in the short term can have an economic effect that would change the way people are feeling in time for the midterms, but they clearly did need to move away from what they were talking about publicly before. And even in the statement announcing the deal, Joe Manchin made a point to say Build Back Better is dead. So they had to do away with the previous branding and refocus on reducing the deficit. That doesn't solve their problems with inflation, but it shows where their priorities have shifted.
Well, the B word is the right word, isn't it? And I'm thinking of branding. For those of you that thought I was thinking about something else, maybe. This from Punchbowl, Jack. This from Punchbowl just moments ago. House Democrats plan to announce a proposal next month to ban lawmakers, their spouses and senior staff from trading stocks, according to people familiar with the matter. Multiple sources close to the issue. Jack, how many different times have you seen that story over the last few months? Is that going anywhere?
That has come up over the last few months. It is a bit more of a major talking point recently. You know, for that kind of bill, you do need, to enact it, you'd need 60 votes in the Senate to change the law. Could they do something with the rules in the House to increase transparency? Maybe. It's difficult to predict exactly where it's going, but it has been more and more of a discussion point recently, and obviously with some scrutiny on Nancy Pelosi's husband, it has become a much more high-profile issue lately.
Particularly around chip stocks over the last couple of weeks. Jack, thank you. Jack Fitzpatrick. Here's a quote from the story, guys. The framework which the House Democratic leadership will release in early August, Tom, would force members of Congress, their spouses and senior staff to choose between putting their assets in qualified blind trusts or completely divesting their investment portfolios.
I get the blind trust idea, John, completely, but what I really take issue with is the single word trading. There's a conflation in the political process of what the word trading is. The vast majority of Americans don't want politicians trading like Lisa's kids do off their couch. We don't want them doing Robin Hood out of their office. And the solution here is simple. Put a minimum timeline on ownership of a given equity. That's all there is to it.
That's one issue. The other is spouses, and Jake Sherman and the team over at Punchbowl acknowledging that at the end of the story, Lisa. Some sources have suggested that the inclusion of spouses is unnecessarily onerous. For example, what happens if a member of Congress's spouse is a stockbroker?
Right.
Does he or she have to quit their job?
Okay, this is all theatrics, right? Because this isn't going to get passed. That's basically what Jack was saying, that this basically is good messaging ahead of the midterm elections. But how much should they be following the same rules that any insider trader, that any big corporate executive would have to follow if they are aware of certain provisions coming down the pike that will move markets and they can still trade off of it? It is logical, and if they're I don't know, to me it just makes sense if their spouses are hearing what they're talking about. Why not be included? I mean,
just down a third of 1%. I'm with you. I'm just smiling as
very clearly.
Tom,
I'm not.
Come on.
Nope.
Tom, if you're privy to decisions that move equities,
put a timeline on the trade. The problem goes away.
I'm not sure if it does. We can talk more about this. From New York City, this is Bloomberg. What is it about Fed Day and the Nasdaq 100? Just a massive day of gains yesterday, the biggest one-day pop going back to November 2020. Then we pull back just a little bit. On the S&P, we're down 0.25%. On the Nasdaq 100, futures down 0.6%. Facebook, a stock to watch, is down in the pre-market. The first ever quarterly sales decline. The stock is down by 5.5%. Later today, we'll hear from Amazon, we'll hear from Apple, and they make up close to, Tom, 20% of the Nasdaq 100. Two big names reporting after the bell.
Yeah, but I'm going to look at the drawdown. John, keep doing the data check here. Oh, I used FB as a symbol. The symbol's not FB, is it?
It's all about Meta now.
Meta,
Tom, I will continue to call it Facebook.
Continue with the data check while I do a Meta drawdown analysis.
You carry on, Tom. We look forward to that. I'm going to talk about the bond market. Put out the ranges for GDP a little bit later at 8:30 Eastern. Positive to close to 2%. The high, the low, negative, close to 2%, and someone messaged me and said you could fit a London bus through that range, and you can. I will say this, though. Some of the more recent forecasts for GDP that come out this morning, the ones that were updated yesterday, they had a big lift to them based on the data yesterday morning, and we'll touch on that in a moment. 297.56 is the yield on a two-year. This idea that the Fed's moved away from peak hawkishness, we'll get into that as well. We're coming in a couple of basis points again, and the 10-year, this is all about weaker growth in our future. 278.31, Tom, and a way off the highs of the year, which were close to 350.
Do we agree, John? The bond market yesterday was really twisted as Chairman Powell was speaking, and I kept looking at the real yield, which I've mentioned has come in with a vengeance is the right word on it, John, but what did you see across the curve?
The front end just dropping, Tom, and moving away, and it doesn't really believe that we've got much left maybe in our future for this Federal Reserve to do? I'm not sure about that. Tom, I mentioned this at the top of the program. I'll say it again. The Fed's trying to shift away from forward guidance, trying to completely become data-dependent meeting by meeting. And I get all that.
That's what they used to do.
But when they shift towards that, the market's just filling in the space, Tom, and seemingly coming up with the conclusion that this is a dovish move because we're moving away from this committed stance to doing a whole lot more.
We're going to go back to what is Chairman Powell having for lunch. John, to bring up to date here, Meta drawdown, 55%.
Facebook drawdown.
It's a Meta drawdown.
Brutal. Would you call that a Meta drawdown?
It's a Meta drawdown.
It's a Meta drawdown. Okay.
Drawdown, however you want to.
I'm pleased you did the word. That was good. Thank you.
Is that it?
We're so done.
Currency, currency's flat here. Euro, John and I are watching. It just flat out really can't get a bid. Lots going on there, particularly nat gas in Europe. Francis Donald with us now, global chief economist, strategist, Manulife. Very good at the workings of our GDP. What are we not analyzing in today's GDP first look, Francis? What's the big mystery?
The big mystery is not today's GDP at all. Today's GDP will tell us what we already know, which is that this economy has materially slowed down. We are not in the roaring 20s. We are not in the reflation trade. And if you told most people that last year, they would not have believed you. The big mystery is what does the next 4 to 6 quarters look like? And this is really what concerns me. It's not recession or no recession this year or even in 2023. It's what do we do if we're stuck in 1% growth for 4 to 6 quarters? That's much harder to trade, much harder for central banks to respond to.
And Francis, what's so important, I featured this earlier, and Justin Fox of Bloomberg Opinion has done great work on it. Powell really skirted yesterday the housing plug-in to GDP, which is if we get yields up, mortgages are slammed, house ownership is slammed, and that means rents sustain and go higher. How does that work into the GDP of the nation?
Well, economists like to say housing leads the market. You nail housing, you're going to get the economy outlook pretty good. In fact, one of my favorite charts is one that shows that housing leads retail sales. So, really focusing on the housing side of the story is going to be critical. It is going to bring down inflation to a certain respect. And it's also very, very bad. Every data point we have on housing is trending downwards. Frankly, Tom, every data point we have across the gamut of major primary data points is pointing downwards right now. There's not a lot of places you could look for optimism, unless you do what Powell did yesterday, which is to call initial jobless claims rise not real or to question the validity of the GDP number.
3 weeks of it now, and we might have a 4th week of it later. Francis, tell me why the market's been rallying then over the last month, why credit spreads have been tightening, and what do you make of that easing of financial conditions we've seen?
Well, bear market rallies, they get bigger the deeper you get into that bear market. I do not believe what we saw yesterday from Chair Powell was a pivot, although it certainly was the path towards a pivot, and markets care about second derivatives. But what Chair Powell told us is, well, he's data dependent. Unfortunately, I don't think that inflation number is going to come down fast enough in the next 2 to 3 months to take out too much of the pricing for 2022. But what this market is going to do, in my opinion, is price in more cuts for 2023. And gosh, that makes the Fed's job harder, just like we saw yesterday. The weaker the outlook, the more we see those financial conditions fall, the more it offsets what the Fed's really trying to do, which is tighten. Look at the break-evens yesterday. They're rallying. That shouldn't be happening when the Fed's tightening 75 basis points. They're probably not happy.
That's actually funny that you mentioned that, because I was just looking at the five-year forward break-evens, and they've been steadily rising the more people believe in this Fed pivot. So what do you expect in terms of pushing back against this? How does the Fed react to a market that's not cooperating and getting ahead of itself?
Well, I wouldn't be surprised if in the next few days, the next few weeks, we do see Fed officials who come out and really try to walk back some of that, speak to some of the hawkish risks that exist in this market. And that's why I think it's dangerous to make too big of a change in your Fed view after a single meeting. And as we've seen this year and a little bit of last year, you can have these big rallies on Fed Day that are then reverse course the very next day. So Fed Chair Powell told us they wanted to be nimble. I think now is the time for economists and strategists to be nimble as well.
Some people who are watching the show, Francis, are probably saying, oh my goodness, here she goes again being bearish. Tom is saying we're sick of talking about recession, companies adapt. And we are hearing around the margin signs that the rally that we've been seeing is a signal that we've priced in so much bad news that people are beginning to find value. What's your argument against that?
Well, I'm not sure if the she is you or me, but bearish has been effectively the right way to do this. And if you look at the economy, it is still trending downwards. Historically, what we would see is that when the economy is about 2/3 of the way through its downturn, you can start to look for opportunities. And I will be the first to say that macro does not rule all. There will be pockets of advantage here. I think we should watch. I think the curve will still flatten, but we will reach a point in the next few months where you want that steepener back on, and there are always bottom-up trades to be had. So the correlation on macro, it does change over time. It's not the be-all, end-all, but the macro does not look good. When it does, I'll be bullish again.
Francis, what do our listeners and our viewers do is they jump from forward guidance and the comedy that it was to actually just looking at the data? How do you actually get through a week, get through a month, get through a quarter where you are data dependent?
It's a great question, Tom, because we don't know exactly what data the Fed is looking at. And sure, we asked him and he said, well, we're looking at inflation. We want to see compelling evidence. What's compelling evidence? Probably a few months of month-over-month improvements in inflation that is heading downward. They're looking at labor supply and demand, but not all data, apparently, because there's plenty of data that says jobless claims and unemployment is moving in the wrong direction. So we don't know the Fed's reaction function as much today as we did even 48 hours ago. And that's going to make a lot more market volatility, a lot more two-sided conversations. One of my fears is that we're going to have a lot of Fed officials speaking to both sides of the argument. So the clarity on what happens next has been reduced very significantly. And if you're at home and you're thinking, what do I look at? Well, I'm in the same boat.
Francis, I can sense the frustration. So let's address it. What do they need to do better?
I'm not sure it's frustration so much as how much harder are you making the job of knowing what you're going to do next. And the Fed's job isn't to make my job easier. The Fed's job is to contain inflation and really improve the employment outlook. But what would be helpful is if the Fed had more clarity on what elements of inflation they're looking at. Now, 2 meetings ago, we heard from Chair Powell that he was very focused on headline inflation. But yesterday, he said core is the best leading indicator. So I'd love to hear more about what really are you targeting? Because we know that, for example, inflation expectations for consumers are driven much more by gasoline prices than they are by Fed policy. So which elements of this are you really trying to control? And do you fundamentally believe that it's your job only your job to contain inflation? Because inflation came from a lot of places. It's going to take a lot of places to fix.
I'd love it if he could make our job easier. I'll say it. I've been incredibly frustrated by the last few news conferences. Francis Donald there of Manulife Investment Management. Bramo, which data point matters and which one doesn't?
Well, sometimes it's the University of Michigan, sometimes it's the ECI, sometimes it's jobless claims.
Sometimes it's not.
Sometimes it's not. Sometimes it's CPI, sometimes it's core PCE. We will find out as the data drips out, and this will actually cause the data days to be possibly more volatile than the Fed days, because that will be when we have to say it's GDP Thursday. It's ECI Friday.
TK can't wait for ECI Friday. Tom, you've said you wanted to get to a data-dependent stance. That's where they are. The problem we have,
we've been here
and it's still the same problem, Tom. We don't know which data point. We don't have a complete understanding of this Fed's reaction function.
Any legit PhD would tell you it's going to be a compendium, a mosaic of data points that matter. To Lisa's important insight there, or Francis, I should say, on core and a headline. John, I'm going to go to what I've been looking at since the press conference, even in the press conference, is housing, single-family home over to multifamily, the dynamics over to rent. And I'm sorry, it's not a pretty picture.
I don't think it's that complicated. I don't think you need a PhD for this one, Tom. The problem is he keeps flipping from one data point to the other, from meeting to meeting. First it was headline inflation matters, then it was core, then it was about you, Mitch, and to Lisa's point, before that it was about ECI. Tom, I'm not sure what the incoming data actually means for this policy decision in September. I just know that the incoming data is important for the policy meeting in September. I'm just not sure how it's important.
To me, it's
based
data
on what we've heard.
I'm sorry, they're going to look at a mosaic of data and have to come to some tough decisions. And John, what's so critical now is he stated somewhat neutrality is now is when the going gets tough.
Well, you saw what Dudley said straight after that, the former New York Fed president. Are we at neutral, Tom?
Yeah,
Are we?
I'm sorry. I just think that now is where it gets tough.
I agree. Futures down
We
a quarter
agree?
of 1%.
Lisa,
we
take
agree
a
on
note,
tons
please.
of
We
things.
agree. Yeah.
We don't agree on
Duly
that
noted.
Congress story and
Well,
regulating
Valier,
how
I
you
thought
invest
Valier, we'll
/ trade.
talk about it later. Valier just published on the bombshell.
Okay, well, let's bring that up again in a minute. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a surprise agreement on Capitol Hill. Democratic Senator Joe Manchin struck a deal with Senate Majority Leader Chuck Schumer on a tax, energy and climate bill. It will enact major parts of President Joe Biden's agenda, such as a minimum corporate tax and allowing Medicare to negotiate drug price cuts. It also requires holding oil and gas lease sales in Alaska and the Gulf of Mexico, which could undercut the bill's clean energy focus. Now, a U.S. aircraft carrier and other Navy vessels have entered the disputed South China Sea at a time of rising tensions between Washington and Beijing. The Navy calls it a scheduled operation. China is unhappy that House Speaker Nancy Pelosi might visit Taiwan, which China considers part of its territory. President Joe Biden and China's leader Xi Jinping are expected to speak on the phone today. Etihad Airways has posted a record first-half profit. Long-haul travel revived with the easing of coronavirus curbs, and the Dubai-based airline added flights to European resorts. Still, rising costs are a growing concern.
Simple reality is we're seeing inflation everywhere. It's not really impacting us with the cabin crew and in terms of direct labour in this part of the world. But where we are seeing superinflation is through the aircraft component supply chain. And that's something that's challenging all airlines at the moment.
Meanwhile, fuel costs were up almost 60% from the previous year. Global news 24 hours a day on air and on Bloomberg Quick Take. This is Bloomberg.
Demand hasn't fully recovered yet. And supply is definitely tight. There is a lot of talk about limited spare capacity in OPEC+, and we subscribe to that theory as well. The amount of crude oil coming out of Russia has not really diminished an awful lot. That might still come, of course, so I think where we are today, there is more upside than downside when it comes to the oil price.
That's the call from Ben van Beurden there, the Shell CEO from New York City this morning. Good morning, Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures negative 1/3% on the S&P. We're down 0.6 on the Nasdaq. Later, Amazon and Apple reporting earnings after the close. Yields unchanged on a 10-year, 278.85 following the Fed decision yesterday. Euro dollar, Tom, negative euro. Euro dollar 101.27. We're negative there 0.7%.
Hugely busy day here, and again, going to the earnings that we'll see this afternoon. Stay with Bloomberg on radio and television all through the day. This big, what is it, John? 19% of market cap?
Just two names on the Nasdaq. Two names make up about 20.
Well, yeah, it's
Amazon and Apple.
Huge deal. This is a lot of fun because she comes with bulletproof academics. Berkeley was known for decades for chemistry, and part of that, of course, is chemical engineering. She's a chemie out of Berkeley. Janine Wade joins us right now with Barclays, their senior U.S. oil and gas exploration and production analyst. Janine, I'm going to cut to the chase. The airlines needed 1, 2, 3 crises before they got capital discipline, before they got the religion of operations. How is oil doing in this boom at capital discipline? Or are they going to go off to the new Siberia and waste it all away?
Oh, good morning. Thanks for having Barclays. I love it. Let's just get right at it. I think you're hitting at the crux of the issue. Capital discipline, whether it's going to hold, is the #1 question from investors. There's a ton of skepticism on that in the market, and that's what's kept people away. We just checked in with all of our companies ahead of the quarter, and every single conversation, the companies were still on the right narrative, which was low growth and max free cash flow.
Okay, well, let's go right to the chase, Janine, just because of time. Chevron has always been the wild card. They're the Arco of the modern world. Explain Chevron's capital discipline. Who is keeping them in line?
Investors are keeping Chevron in line, just like how they're keeping every other company in line. Energy was the worst performing sector for a number of years, and then that's because they were destroying value, no returns, nothing was getting returned to shareholders that was anything meaningful, and the shareholders are spoken. And what Chevron did was they reduced their capex budget by $5 billion a year for the next 5 years, which is huge. And they've embarked on a big buyback program. You know, the buyback right now is $5 to $10 billion, and we think that they're going to raise the low end of that. We're already at $10 billion for the year, and we think our investors are also at $10 billion. So the market has really instilled capital discipline on the whole sector.
Janine, earlier this morning, Shell posted a record profit for the second straight quarter, and they also accelerated buybacks. Tomorrow we get the likes of Exxon and other oil majors that are reporting in the U.S. What's the political risk as they start to report these blockbuster bonanza earnings on the heels of oil prices that have become a campaign speaking point?
Right. We have midterm elections coming up in November. It's a huge focus. Oil companies are definitely in the crosshairs because of all the profits that they're making. But let's just face it, you know, the companies are making a lot of money because oil prices are up, but they didn't make a lot of money for a lot of the other years. So what they've been doing with the cash is they've been enhancing the balance sheet and they're giving the money back. So, you know, we already saw that companies are delivering on this show me the money mentality that investors have right now. We think that Exxon could potentially talk about their $30 billion buyback program. They just tripled it last quarter, so it's unlikely that they increase it this quarter, but we think that maybe there could be some shifting or front-end loading of that. We just talked about Chevron, how we think they're going to raise the bottom end of their buyback guidance, and so that'll bode very well. But, you know, companies have a couple of options. They can either reinvest in growth with all that cash, and that's pretty much a no-no right now. They can pay it out via dividends and buybacks, which we think they're doing, or they can hoard the cash.
But that's exactly the point. It's a no-no right now to invest in more production at a time when a lot of politicians are saying that's exactly what's required of these companies. What is the risk? How do you price out the chance of perhaps some sort of excess tax put on these companies if they don't invest in production, or some other policy kind of check to try to, if nothing else, be a talking point heading into the midterms?
That's a good point. We think the political risk in the headlines is very high, again, because we have midterm elections. But in terms of anything actually getting through, we think the risk is low. So we've seen a windfall tax in the UK. We think that's highly unlikely in the US right now. Oil companies, they need a more consistent, friendly fiscal regime and a constant regulatory environment in order for them to really commit to plans and to increase growth. And when they don't have certainty in what taxes are going to be, if permits are going to go through, if fracking is going to be allowed, that's when they're not able to plan. And then you won't see as much production growth.
And policy continuity, it's a massive problem, has been for a while now. Janine, thank you. Janine Wade there of Barclays. This from the White House, some guidance from them. 2:15 Eastern time, Tom. We'll hear from the president delivering remarks on the economy. Tom, GDP's out a little bit later. Now, I have to say, if the administration didn't make as much noise as they had about this whole idea that it is a recession, it's not a recession, I wouldn't really be paying attention at 8:30. I'd expect just a positive print and move on. It kind of spooks you a little bit, Tom. Makes you wonder what we're going to get at 8:30 Eastern.
And even more importantly, folks, you have to realize there's a second and third look as well, and the real adults only wait for the third look. I mean, when everything's adjusted out. But come on, it's a political football into an election season, so I'm not surprised that he's going to trot out whatever the message is, including trumpeting this bill. John, I got to say, Greg Valliere was not scathing, but he made clear this is a bombshell piece of legislation. The president's, I'm sure, going to take a massive victory lap on it. And Valliere says, by no means does this look to be passable, mentioning even the funding to the IRS.
Yeah.
I mean, it's fascinating.
It's
very sophisticated.
It's a big win, a big change in the last 24 hours or so.
Yeah.
Lisa, I imagine we'll address that GDP print too. It's become so political in the last week.
Well, partly because it reflects the pain that people are feeling. So then if they can put a narrative on it with numbers behind it, that starts to get a little bit stickier in terms of a narrative, and it becomes more difficult to dispel heading into the midterms. Perhaps it's easier to say, look at oil prices, look at energy prices, gas prices are coming down because of the SPR release. That's a simpler story to tell than a bifurcated, where is the inflation pressures, is employment picking up, et cetera, which is nuanced and doesn't play well in politics.
Tying yourself in knots trying to explain the GDP story. Tom, Gas prices are down every single day since the middle of June. Continues to be the trend. I see so many tweets. The media talk about it. The media, we do every single day.
Yeah.
I'm doing it again. Gas prices are down every single day since June.
Yeah, I'm looking at, it's away from the ugliness, but where people are going like, where were we before whatever their framework is, 2-3 years ago, and we're up off those lows. Program note, John, and this is distressing. I didn't know Harry Keene is the only one on the planet who can hold at 29 years old.
Hold what, Tom?
It's his birthday today.
Oh, right, okay.
And he's like holding.
How do you know this stuff?
29, forever.
What does the holding bit mean?
He's not going to ever turn 30.
Oh, right.
That's the way it works.
He's like permanently 29.
Permanently 20, like you.
Is that what his agent is telling you?
Yeah.
So that he gets a better contract?
I hope so.
Is this the agreement that you were promising me for the rest of the show?
Birthday. Happy birthday, Harry.
If you're a Fed who cares about inflation or cares about unemployment, the right thing to do is to address inflation head on.
For now, they're very much still steering towards higher interest rates and higher inflation. So I don't think they're going to pause.
The economy's been stronger than I think the people realize.
We do think that the market is over expecting a Fed pivot in the near term. I can't see how that happens.
I don't think the pivot will occur as soon as some people are hoping for.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is GDP Thursday, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative 0.25% on the S&P. TK, the data, 90 minutes away.
Yeah, we're going to pivot to the data here, 90 minutes away, and pivot and go into it, go beneath the headline data. Michael McKee giving us great assistance on that. John, I'm going to look at the data. I got to admit, I'm going to look at the export-import dynamic. I thought Bruce Kasman was brilliant on that the other day. John, can I just say, before we get carried away with pivot, right now the Red Sox are pivoting, okay? What does pivot mean? I mean, it's like with President Obama when we were pivoting to the Pacific Rim. It's just, what is pivot?
How did that work out? Tom, it's this idea that you go from 75 basis point hikes down to 50, down to 25, maybe you pause, and then eventually have to go the other way. It's a change. We've gone to a data-focused Federal Reserve. Tom? Forward guidance is gone. You know all these things. And the market has found the little gap and decided that that is a dovish tilt from this Federal Reserve. Tom, do you think the easing of financial conditions are desirable or undesirable
this is really
for this Federal Reserve? And I think that's got to be the big question after the move we've seen.
And Alarian was brilliant on this yesterday in parsing out the financial system versus the real economy. What can they really do to manipulate the real economy? Do they have control of the real economy? And the answer is not.
He kept saying things like there's more tightness, more tightening coming through the pipeline based on what we've already done. Lisa, it just gave everyone the impression that he was ready to wait and see, look around and see what happens.
Really? I mean, I'm not sure. We're not sure what he is actually intending. I don't think he knows what he's intending. I'm talking about Fed Chair Jay Powell in terms of where the economy is going, because they are aware of both risks. And I think that's what people are keying into, at least according to a lot of analyst notes. The fact that the Fed is saying we understand that if we go too fast, too far, we could cripple the economy, even as the economy is weakening, at the same time that they have to fight inflation. The fact that they even gave a nod to that other risk was enough to make people bullish on equities.
The Citi are taking the other view. They say this, and Andrew Hollenhorst put this out in the hour after the decision. We read Chair Powell's press conference as more hawkish than the market's interpretation. They continue to expect core inflation to push the Fed to hike more aggressively than they or markets anticipate, with a 75 basis point hike in September, policy rates reaching 4% by year end. The market's interpretation, as we clear the risk event yesterday, is very different to what's going to happen in the next couple of months, potentially, Tom. We're going to be highly data dependent, very, very sensitive to it, and there's a lot of data still to come before we get to September. And I imagine, Tom, we're going to whipsaw from one interpretation to the next based on the incoming information.
And I'm going to go back to where we are, which is neutrality is described within a fairly wide band. And once we get to the neutrality, you move on to the first restrictive step. Again, not really knowing where it is. Is it September, or, John, do we really focus on November to keep employed?
For you or for Chairman Powell?
For me. How about, seriously, John, Janet Yellen off of the bill last night, how long is her employment at Treasury? The global tax thing went down in flames.
The minimum tax.
Yeah,
Senator Manchin maybe breathing some life back into this administration, at least for now. We'll hear from Secretary Yellen later. Lisa, we'll hear from the president too later this afternoon.
He's going to be speaking at 2:15, talking about the economy. How is he going to message it? Is he going to talk about the strength? Is he going to be talking about the need for the Fed to be aggressive? How is he going to head into a midterm elections where a Fed is saying that a rising unemployment rate is by design? A very difficult political message.
Who wants to say that out loud? Not the Fed right now. Futures down 0.25% on the S&P. On the Nasdaq 100, we're down 0.6%. Yields unchanged on a 10-year, 278.85. Crude inching back to $199 and about 12 cents. Euro dollar 101.34. Just getting some confirmation from the White House, Lisa. They have confirmed the time for Biden and Xi to have talks, 8:30 Eastern time.
Yeah, and we've been wondering when this would happen. 8:30 a.m. seems to be the time. We're also going to be hearing from President Biden at 2:15 p.m. We'll get to that in a second. At 8:30 a.m., we also get second quarter GDP numbers. It is GDP Thursday. How much is that going to shape anything? I actually don't find it as interesting as initial jobless claims, because right now, how much does the labor market dictate whether the Fed starts to reconsider how quickly to raise rates heading into the year? Because that seemed to be one of the reasons why Powell seemed to think that there was still strength in the market. So going to that 8:30 call that President Biden is going to be having with Xi Jinping, we have confirmed that it's at 8:30. How much is he going to talk about lifting some of those tariffs from the Trump era? At 1:30 p.m., we're going to hear from Janet Yellen, Treasury Secretary, speaking about the economy. 2:15, we'll hear Biden reignite some sort of debate about what a recession is and how strong the economy is. That'll be really interesting to hear. Then, of course, after the bell, we get a slew of earnings. 56 companies are reporting in the S&P, accounting for about 19% of the total market cap of that index. And, John, as you were pointing out, Apple and Amazon account for about 20% of the Nasdaq index. Both of them really to give interesting reads on the consumer, especially interested in Apple, considering the recent price cuts in China, considering the slowdown that we have seen in demand for semiconductors as well as personal computer devices.
Bramo, thank you. Looking forward to those earnings a little bit later after the close, if we can stay awake. Chris Harvey, Head of Equity Strategy at Westfalco, joins us right now. Chris, it's good to catch up. What did you make of the dovish interpretation of this market after that Fed meeting yesterday? Is that something you endorse or something you want to fade?
No, it's something I endorse. One of the things we've been talking about is we're seeing cyclical inflation peak, right? Prices are coming down, whether you look at the commodity prices are coming down. Break-evens across the board are coming down. My 401k is coming down, so a negative wealth effect. And overall, what we're seeing is what you would expect. Financial conditions tightening, the economy slowing down. And we don't talk about pivot. What we said is when the Fed toggles things down, and the Fed has toggled things down, that's when the equity markets can start, holding gains. And I think they will hold gains as we go forward.
Chris, for Factor success over the next 12 months, how important is sector analysis? To me, it's as critical now as it's been in, say, 20 years.
Yeah, Tom, we spend a lot of time on factors because what we see is typically across all the capital markets, a factor really influences price, sector, stock. Last year was duration. Duration expressed itself across the fixed income markets, the equity markets, U.S., international markets. And what we've seen over the last couple of weeks is we've seen more of a risk on as people, I think, since CPI really interpreted the Fed to become a little less hawkish, right? There was demand destruction. Prices did come down. And again, I'll harp on break-evens. Break-evens across the board have come down and come down significantly.
So, Chris, what's the risk that the opposite is happening now and will actually prompt the Fed to be more aggressive? I was looking at break-even rates, and if you want to take a look at those, and people will disagree on how noisy they are, they've been rising in the past few days on the heels of this belief in a Fed pivot. Basically, the more people believe that the Fed is going to back away from their rate hikes, the more they see longer-term inflation rising well above that 2% goal. At what point does the Fed smack down this market and basically say, you guys are operating away from our goals?
There we
go. Yeah. I don't know if smacking down the market is part of the Fed's dual mandate. As far as break-evens, there is some noise. One of the things that we thought is break-evens were going to be in a 250 to 275% range. They're now in a 225 to 250% range. So it's much lower than we would have thought. A lot of people are saying, well, that's 10 years, but look at 5s and 2s. right across the board, across maturities, 5-year break-evens, everything has come down. And that's what we expect. We are seeing demand destruction. We are seeing commodities come down. We are seeing the economy slow down. And so you would expect commodities to come off you would expect inflation to come off the boil. Yes, there is some geopolitical risk, and that's going to keep it elevated for some period of time. But that cyclical inflation is coming down, and that makes a ton of sense to us.
I don't think the bear got much sleep last night,
No.
TK.
No,
at all.
I don't think so.
Chris Harvey
Chris,
of Westfalco. Bared up Bramo.
No, I'm not bared
Do you know,
up.
do you know who's on the same page as you?
Yes, Bill Dudley.
Neil Dutta
Yes,
too.
actually, I
of
saw
Renaissance
that.
Macro. Let
Neil-
me read the quote for everyone.
I just want to let you know, Neil, I read this last night. My heart went out to you.
The fact that the Fed hiked 75 basis
I don't
points
know.
and financial conditions have eased is a problem. Renaissance Macro go on to say, looser financial conditions make the Fed's objectives more difficult to achieve, Lisa. Pricing in cuts after you have hiked undoes the efficacy of hikes in the first place.
This was what Bill Dudley said. He even put a number to it, that a 5 to 10% stock market rally would cause the Fed to see that that was moving against what they were trying to do, and that would cause them to really give guidance, even though they're not giving guidance, that they don't want to see that. How much does this become just a churn, right? And I think that that's what people are looking at, and that's what Frances Donald, maybe she doesn't call it frustration, maybe exasperation, with the complete lack of guidance that everyone's feeling. How do we see that expressed in the price action?
From two different worlds. This is really important, folks. We do economics, finance, investment, international relations, and Ferro demands we do politics as well. John, what you just saw there was the Yardeni-Harvey pivot.
Sure.
Coming from two different parts of this industry, and the giant economist Ed Yardeni and the incredibly competent Chris Harvey both said the same thing. There's a point where you pivot to risk on, and maybe that's in the continuum of this summer, what we've seen.
They're not alone, and that's been the market interpretation, I would argue, not just of the last 24 hours, but of the last month.
And you're never on board then. You never see it. That's why I'm in triple leveraged all cash. I never see the entry point.
Yeah. Tom, the difference between a bear market rally and a recovery, you find out pretty late, don't you?
Yeah, the cliche, John, in America is the boat left the dock. And the answer is, I've never gotten on the boat, to be honest, but where's the boat? Where's the dock?
I've got
what
no
are we
idea
doing?
where we're going now.
You heard Yardeni.
You've totally lost me.
No, you heard Yardeni there, and I'm sorry. Ed Yardeni said, climb on board. June was the bottom.
8:30 Eastern Time, we get GDP, and if you're just tuning in, we'll also have a call between President Biden and President Xi at the same time. So that's 8:30. Then a little bit later, the president's going to talk about the economy. What time is that, Lisa?
He's going to talk about it at 2:15.
2:15. There we go. Bramo, with the promo for the Fed this month, was taking a sledgehammer to inflation, and now it's all about, what was it, slamming down markets, slamming them down. Futures down 1/4%.
Come on, it's Thursday.
I know. I didn't sleep either. From New York.
It's Harry Kane.
This is Bloomberg.
It's Harry Kane Thursday.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a surprise agreement on Capitol Hill. Democratic Senator Joe Manchin struck a deal with Senate Majority Leader Chuck Schumer on a tax, energy and climate bill. It will enact major parts of President Biden's agenda, such as a corporate minimum tax and allowing Medicare to negotiate drug price cuts. It also requires holding oil and gas lease sales in Alaska and the Gulf of Mexico, which could undercut the bill's clean energy focus. Now, Fed Chair Jerome Powell is signaling that more rate hikes are coming. Powell spoke after policymakers raised the benchmark lending rate by 75 basis points. He said the Fed will press on with the steepest tightening in a generation to curb inflation. At the same time, Powell stepped away from the Pacific guidance he gave at the June meeting. Strong words today from North Korea's Kim Jong-un. He marked the 69th anniversary of the deal that ended fighting in the Korean War by threatening to, quote, eliminate South Korea. Kim also said he was ready for any battle with the U.S. North Korea is believed to be preparing for its first nuclear test since 2017. JetBlue has agreed to buy discount carrier Sprint Airlines, the price at least $3.8 billion in cash. The deal comes less than a day after Sprint ended a pending merger with Frontier because of a lack of shareholder support. The deal is likely to face a stringent review by antitrust enforcers in the Biden administration. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
And that was rocket fuel for the Nasdaq. That was Chairman Powell yesterday in the news conference from New York City this morning. Good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures down 0.2 on the S&P. On the Nasdaq, we're -2 by 0.5%. Negative as well, not -2. You get where I'm going. Anyway, in the bond market, yields unchanged, 278.31.
No one's left.
On a 10-year. No one's following anymore anyway. Euro dollar 101.31. Did you have a dovish interpretation of Chairman Powell yesterday? Is that something you endorsed, that stance? Chris Harvey said it's something we endorse. What did Jeff Rosenberg of BlackRock say yesterday? It's hope over experience, Tom. That's what he said. It's hope over experience.
It was good to pivot to Mr. Rosenberg yesterday to get that perspective late in the program. I was numb at that time, so I sort of
You were done too, Tom.
I missed the
You
conversation.
checked out.
But there we were. Thanks to our team for just exceptional conversations yesterday. Now, Jack Fitzpatrick gives us an exceptional view of a busy day for the president. Jack, I've got to rip up the script and just get to the program for President Biden today. I assume on this call with President Xi, it's not like with President Trump where no one's involved, he's on his cell phone out in the parking lot, that there's a lot of people involved in the call. What is the number one goal of the president and his team as he speaks to a beleaguered Xi who has COVID to worry about?
The number one goal, if you listen to the way the White House casts this, is to avoid surprises. You know, when they describe this, they sidestep some of the major issues that we're looking for, a potential Pelosi trip to Taiwan, tariffs, and tend to say, you know, keeping the line of communication open with China so that neither side ends up surprised by the other in a negative way. They don't necessarily play this up as something where they have a major policy goal to get at. It's still very fair to wonder, one, will there be a conversation about that potential Taiwan trip? Does Biden try to dissuade a really aggressive action in some way by China, which has hinted at potentially some sort of military related response if Pelosi does go to Taiwan? We've been wondering ever since we heard about this call if there would be a conversation about the lifting of tariffs. But the White House itself tries to minimize the major headline goals and say you want to keep the lines of communication open and have no major surprises.
What is the major headline goal of this afternoon's economic conversation?
It's a bit more, it's a bit easier for the president in terms of how he communicates this stuff publicly. Having the agreement with Manchin and Schumer allows him to talk more about what they're planning to do, what they hope to pass in the Senate next week, rather than getting bogged down in a conversation about what a recession is and whether we're in one. So I would expect a response, a further response from the president to the Manchin-Schumer deal, and sort of a combo, you know, here's what we've done on jobs, but we also still take inflation seriously, and the sort of branding of this legislation as something anti-inflationary, maybe a little bit overboard, but it's still sort of the branding they're going with. So he's got a positive spin to put on the latest economic talk because of that deal.
Jack, is the branding working based on the popularity polls?
You can only brand it so much. Right now, things are bad for a lot of people. I mean, inflation has hit people pretty hard. People are feeling very negative. The polling for the president is not good at all. But you do still need to show that you are doing something, and having a list of accomplishments can help in the longer run. It doesn't fix the inflation problem now, but he's going to, if he campaigns for re-election, that matters for all the people campaigning for re-election in the midterms. times that matters, and to feel good about the chances of passing a major climate and tax bill as well as the prescription drugs, that's a lot better than nothing for Democrats.
Do you view it as coincidence that President Biden is holding a call with Xi Jinping at 8:30 where potentially is going to be talking about tariffs and then talking about the economy at 2:15 when a lot of people have been speculating that removing some of these tariffs would help alleviate some inflationary pressures, albeit on the margins, for U.S. consumers? What's that dynamic going to be like? Or do you think that that's just simply a coincidence of timing?
When it comes to scheduling these kinds of calls, that may be coincidental. I'm not sure they have the ability to line these up in ways that are perfectly convenient for them. But, you know, in the macro sense of the fact that he's having a call around this time, not at 8:30 specifically, but the fact that he's communicating with China, if he does choose to bring up the tariff conversation, that definitely is tied to inflation concerns and him trying to do Biden trying to do everything he can on it. It's very difficult for them to line up these calls in a politically useful way in terms of the exact time. But the fact that the call is happening and that they have not ruled out this conversation on tariffs is as relevant as you seem to think it is.
Hey, Jack, thank you. Jack Fitzpatrick there of Bloomberg Government down in D.C. Bramo, I found the communication to be so confusing. They've got to take the win later, haven't they, when we hear from the president? Focus on the legislative win that we're about to get.
Well, that seems to be what they're most likely going to push forward, because as far as the GDP data goes, even if we do miss a discussion about a technical recession or not, we are still seeing slowing growth in the United States. You're still seeing inflation that's too high. They have to seem cognizant to the pain that certain American families are feeling, while at the same time saying, here's what we're doing about it. And he actually has something to say, we're doing.
The last week's become ridiculous for me. If it's a recession, everything's bad. If it's not a recession, things are good. Tom, it's not that binary. It really isn't. No, it's way more complex. And I find the recession issue, John, is one of timing, but also anybody that would look at, say, 6, 7, 8 previous recessions, they're all different, and the magnitude of the recession is just as important. This idea of soft recession, growth recession, a positive number, whatever. It's way unsophisticated. John, I got a question. Sure. Can I pivot? I'd like to pivot if I could. This sounds like a hard pivot is coming, but go on.
I'm really looking at housing the last couple of days.
Where are you looking?
Why is housing in the United Kingdom shockingly expensive?
Don't get me going.
What's the why there?
The problem is, Tom, that every time we have some kind of house price correction, what the government often does is start to work on a demand-side solution to get prices back up. And every time we've got a house price problem, because they're too high, to solve that, they come up with a demand-side solution. So they're constantly trying to support house prices. Tom, it's very, very political. Obviously, for politicians, they don't like to see house prices go down. What we need, though, is a massive supply-side effort in the UK, and that's been the story for a long, long time. I can think of the Help to Buy program.
Yeah.
I can think a few weeks ago, they were talking up 50-year mortgages, Tom, to try and make buying these houses at these prices more accessible.
Well, that's what's happening in cars in America. You got 7 and 8, 9-year car loans.
It's getting silly. From New York.
That was a good pivot.
This is Bloomberg. A couple of times for the diary today, 8:30 Eastern, GDP in America. At the same time, the president of this country, the United States, President Biden, is going to have a conversation, talks with President Xi of China. Then later you'll hear from President Biden at 2:15 Eastern Time. Going into that, futures slightly negative. We pull back just a little bit, down 0.2% on the S&P. On the Nasdaq 100, we're down about 0.6%, following the biggest one-day pop on the Nasdaq 100 going back all the way to November 2020. A dovish interpretation of Chairman Powell in the news conference for many of you, I know. For many others, the opposite, including Andrew Hollenhorst over at Citi, who believes we can get still the Fed funds to 4% by year end. That's the view over at Citi. They keep that view. In the bond market yesterday, yields in. This is what it looks like this morning. 2s, 10s and 30s. Your 2-year yields in again by 2 basis points. The 297.36. So the curve just a little bit steeper, led by the 2-year, coming a little bit lower. Again, GDP, 8:30 Eastern Time, and the range about this wide. Mike Ferrodi at JP Morgan, Tom, looking for positive 1.4%.
Yeah, export kick.
Mike Gapin over at Bank of America looking for negative 1.5%. a big range
and again,
on Wall Street.
You know, John, the formula is Y equals C plus I plus G, then all the export-import noise as well. Consumption making up 70% of the economy, but the adults don't look at consumption. They look at the investment dynamics. Off the top of my head, 11% of GDP. And the major mystery off inventories, John, is the export-import dynamic. And no, I'll be honest, I don't think anybody has a clue. They're just guessing.
XM, that part of it, Tom, just a little bit better yesterday.
Yeah.
The trade balance, that improved.
Which is where Feroli is.
So that's the good news. And that's why, Tom, to your point, the updates that we saw yesterday, they lent in that direction. That's where they were leaning. Just a little bit of a lift to some of those forecasts.
A little bit of a lift here, and maybe that gets you above zero. The president will discuss that this afternoon. We'll have full coverage as well. Futures at -9.
Thank you, Tom. I'm going to hit the euro just briefly. I'm going to squeeze that in. Euro-dollar.
Pivot.
Confidence in Europe. Sentiment. 17-month lows. Euro-dollar right now, 101.31. Deeply negative. Europe has problems, and I think this was the point that Kit Jukes of SocGen was trying to make in his morning note this morning, that even if you think the dollar has peaked, this maybe isn't the one to play it against, given how many problems exist in the Eurozone right now. 101.30 on euro-dollar. That's the cross-asset price action. Tons of earnings. Bramo's going through it for you. Let's get to Lisa now. Hey, Lisa.
Hey, John. Let's talk about problems. Let's talk about meta problems. The meta drawdown that Tom was talking about, 55%. Add to that 4% ahead of the open here after they reported their first ever revenue drop. Not good, even after the constructive tone that we heard from Alphabet and Microsoft. How much is the meta pivot not really working, even though I kind of like its existential feel? And it says that it's still investing in its metaverse, even though Facebook still is the nuts and bolts of the company. Qualcomm came out and actually downgraded its expectations for its quarter as a result of less demand for consumer goods, for computers, for PCs, for your smartphone. How much does this really feed into what we're going to see after the bell today? And how much is this really consistent with what we're hearing from other chip providers, other similar semiconductor companies? And Etsy, on the flip side, talking about how each story is separate. Tom, I know you want your knit hat for vet bill. 8.9% gain. They actually beat on their expectations with a result of more traction on their platform. After the bell today is really when the big fireworks happen. Apple and Amazon, as well as Intel, although that's probably a little lesser story. How much does Intel confirm what we saw out of Qualcomm and out of others? Apple, I am very curious to see whether they are seeing the same kind of trend that Qualcomm is talking about, less demand, whether the China story with them cutting pricing is actually something much broader. And with Amazon, those shares being down so deeply, Tom, how much further can they go with consumers pulling back? But more importantly, with Amazon, how much are they going to continue to cut warehouse workers and cut staff that they built up during the pandemic?
I agree. The conference call with Amazon folks, it's going to be fascinating of the rapidity of solving the box business problems. Lisa, it's a huge mystery.
Yeah, especially after UPS came out and said they were seeing less take-up. Is that an Amazon issue as well?
Yeah, our households trying to make up for that. Right now, Jane Foley joins us with strategy of foreign exchange and at Rabobank, and always with a broader view. Jane, you, like others, have a view of weaker euro. If we get below parity nicely, we get trade-weighted euro really back through 2015 weakness. What does it mean for Europe? Does it mean they have an export boom? What is the actual outcome of a 0.95 weak euro?
Well, you've got to bear in mind that Germany, as its largest export partner, has China, and China is suffering from weaker growth too. But also, we've got to look at the supply chains here too, because if Europe is in recession, it's probably because of really high gas prices. It could be because we've seen certain German industries, maybe Italian industries too, having to ration energy supply, maybe shut down some of those industries. So exports could really be suffering if that is the case. So they don't necessarily get that boom that you would perhaps have normally associated with a weaker currency. It's sort of the horse leading the cart in this instance. But, another thing that we could see was, the weaker exchange rate ramping up imported price pressures. And, of course, Europe is an importer of energy, and that's exactly what they don't want them to see. And, of course, in this instance, energy prices act really like a tax hike into the profit margins of corporates and also into the pockets of households. So a very uncomfortable situation, I think, is facing the Eurozone this winter.
Jane, I think people are itching to keep that short on the euro. The problem is, after the Fed, they're wondering whether it should be against the US dollar. What's the best way of shorting the euro right now?
You know what? I still think euro-dollar is a fair bet. I mean, yes, you look at the US dollar and you might decide, you know what, we're closer to peaking. Maybe the Fed's not behind the curve anymore. Maybe we've got a US recession next year. But I'd raise you the question: if you're going to sell the dollar, what are you going to buy? Because you certainly don't want to buy mostly, EM in this sort of environment. You've got China slowing, Europe in recession, maybe the US in recession next year too. And if we look at the problems throughout many of the developing emerging market, well, we see some even more nasty scenarios potentially developing here, with high levels of dollar-denominated debt, very high levels of energy imports. China slowing. China is the world's biggest consumer of commodities. So many emerging market economies are reliant on commodity sales, for instance. So it's not a very pretty scenario, and I think this is why, despite the domestic issues related to the debate about the US slowdown, I think the dollar will remain pretty firm, because what else do you buy? And certainly, yes, there's been some movement into Aussie, for instance, recently. You might be able to cherry pick a few markets, but I think the dollar could remain firm despite the issues of the US economy, because everywhere else could look worse.
John, have you heard anyone be bullish on the euro right now?
I struggle to find them.
But that's actually the point. And Jane, I wanted to ask you about that, because right now I've been seeing a lot of 95 prints for the target on the euro dollar call, and that seems to be the increasing consensus. Are you on board with that?
Yeah, that is our target. I mean, we all know that there's a lot of options just below the parity level. If we did dip to say 99, it could move quite quickly from there on in. But part of this is the Italian situation too. There are elections in Italy in September. The opinion polls suggest that the far right, is neck and neck there with the centre left. And if the far right do get a lot of power, they went in support of Draghi's policies. It could mean that a lot of reforms do not go through, and that leaves question marks about whether or not Italy is going to get all of its EU recovery, COVID recovery fund money as well. So there's a lot of uncertainties that really do need to be clarified. And right now, I just don't think investors want to take that risk.
95 is going to be a big pain point. It's going to import a lot more inflation for the euro region. What's the ECB's response?
I think it's going to be very difficult for the ECB. It's really walking this tight rope. I mean, it wants to keep yields down in the periphery, and it says because it wants monetary policy to be spread out evenly into the system. But actually, will investors want peripheral debt if we do see, recession looming? If we do have fears about rationing maybe in Italian industry, certainly perhaps if the far right do get a lot of votes in that election. And yet at the same time, the ECB needs to keep inflation expectations down by hiking interest rates, whilst we've got consumer confidence and business confidence now, falling off a cliff because of the energy price rises. So a very, very difficult situation for the ECB. So maybe for now, they're going to keep talking hawkishly in order to get those inflation expectations down, but it's going to be very, very difficult. I would not want to be in their shoes over this winter.
Let's see what the data looks like when they convene September 8th. Jane, thank you. Jane Foley of Rabobank. TK, you'll love this. Pick it up. Euro yen. What a move today.
Yeah.
1.4% in the yen's favor.
Yeah, it's very asymmetric. I noticed that, John, coming in. If you look, folks, at the Bloomberg, you put 20 or 30 currency pairs up, you can see where it's ebbing away, and it's wildly asymmetric. Weak euro, John, yesterday.
Weak euro, strong yen. Now, could that be where we find some performance, Tom, in a way that we did not through the front half of this year?
Yeah, and then you look at dollar yen to see and to confirm that strong yen. And yes, I'll take your point, under a 136. You get that, but to me, it's just wildly weak euro. And John, that's got to come off hydrocarbon. And I noticed I think it was Javier Blas had a coal angle today. And coal usage in Europe, I believe it is back to 2013, which is just stunning.
Germany reconsidering, Tom. Germany reconsidering the approach around nuclear as well.
Yeah, 3 plants.
Which we've been talking. How long have we been talking about that for now, Tom? The legacy of Chancellor Merkel.
And
it's not
Mr.
turning out to be great. Yeah, I would go back that far too. I mean, we said it a few times over the years, Tom. Will economic historians judge that tenure favourably? And by the day, by the week, by the month, it's looking worse and worse.
And what's important here to Jane Foley's wonderful comments, John, is into the fall. Forget about the winter and the gloom of Keating. This is a hugely fungible story. There's all sorts of optionality here away from the war. I'm still struck, John, by how so many of us are removed from what is a real war.
Couldn't agree more, Tom.
It's not in
I
our
think
analysis.
that's less so for the Europeans, Tom. I think it's still very, very real, considering what the continent's going through, and obviously Ukraine much more. Lisa, the front half of this year was all about inflation. The back half is about weaker growth. Will it be about weaker growth and inflation? That's the toxic mix that these central bankers don't want.
Call it what it is, stagflation. How do they combat their worst nightmare?
Do that voice again, Tom.
I think inflation.
Just do a toxic mix.
I like what Goldman
trailer.
Sachs wrote this morning. Goldman Sachs
Nice.
pushed against stagflation this morning.
Is that what they did, Tom?
Yeah, they
that's
brought wage
fascinating.
growth way down.
Very cool. Futures down 0.25%.
They pivoted.
Not very cool that they've brought wage growth down.
We
Anyway,
understand. Interesting.
People don't get it, because then you get hate mail, and obviously I don't mean that at all.
No, you don't.
Anyway, I'm sensitive too, alongside Tom Keene, who's also sensitive, and Lisa, who's just angry.
Who's a brick.
This is
Okay,
Bloomberg.
Can you get me some Tang? This is...
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a deal that breaks the long deadlock on major parts of President Joe Biden's economic agenda. Democratic Senator Joe Manchin and Senate Majority Leader Chuck Schumer have agreed on a tax, energy and climate bill. It calls for a 15% corporate minimum tax and would allow Medicare to negotiate drug price cuts. But Manchin blocked expanding the state and local tax deduction known as SALT. A U.S. aircraft carrier and other Navy vessels have entered the disputed South China Sea at a time of rising tensions between Washington and Beijing. The Navy calls it a scheduled operation. China is unhappy that House Speaker Nancy Pelosi may visit Taiwan, which China considers part of its territory. President Biden and China's leader Xi Jinping are expected to speak on the phone today. U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart about a deal to free imprisoned basketball star Brittany Griner and other jailed American. Bloomberg has learned that the U.S. would swap them for a Russian arms dealer it holds. The Kremlin says there's no deal yet. And Shell has reported record profit for a second quarter in a row due to high oil and gas prices. The London-based company also announced it would buy back a further $6 billion of shares in the third quarter. Shell's second quarter net income was almost $11.5 billion. This is Bloomberg.
I worry that the story of this year will be the Fed lagging the economic weakening. What's the most likely outcome? I would say it's equal between this Fed remaining committed to restoring its inflation credentials and therefore causing undue damage to the economy, and the stop-go, the flip-flopping Fed. There is no good outcome in all this.
There is no good outcome in all of this. It was just great to catch up with Mohammed yesterday. Mohammed El-Erin, their Bloomberg opinion columnist from New York City. This is Bloomberg. Equity futures negative 0.25% on the S&P. On the Nasdaq, we look like this. We're down 0.7%. Yields TK unchanged, 277.94. GDP data, 42 minutes away.
And a president with two events, speaking with the leader of China and then speaking to America on the economy here this afternoon. Right now to earnings, Kriti Gupta. I'll get it out. 3, 2, 1. Kriti Gupta with a chart that speaks better than I do.
You got it, Tom. Let's start with the earnings story. About 10%, more over the 10% of the S&P 500 reporting after the bell today in just two names, Apple and Amazon. So let's take a little walk in the park here, walk back into history, a 5-year chart of just how much these two names actually make up of the S&P 500. For our radio audience, stick with me here. You're looking at two lines, a white line that really signifies Apple's share of the S&P 500. It goes up, up, up through 2020 and then stagnates around 7% average. Since then, Amazon, a completely different story, going up, up, up through 2020 and then making a complete round trip. They're both big tech, Tom, but Amazon with their shipping constraints, with their consumer exposure, just not holding up the way Apple is.
And for those of you on radio, Apple getting it done, Amazon, okay. This is important, and what you need to know is you need to hear the conversations while we're on commercial break. John Farrow and Walter Piecyk of Lightshed on the absolute tensions of the front line of Liverpool. This is Salah and Mane. Walter, Liverpool, their front end, they're not on the same page. I mean, there's some real tension there. Is Apple on the same page, or is it a Salamane metaphor?
First of all, Tom, for not being on the same page, Liverpool almost pulled off 4 trophies last year. It was tight at the end, but that's. And I guess Apple being on the same page with earnings this quarter, probably. But as you know, with the kind of concern over inflation and the economy,
right?
A lot of the focus is going to be on the outlook for next quarter.
I want you to discuss the pricing power Apple has to manage down the income statement. I never hear a discussion of if they go, margins are under threat at whatever line on the income statement, do they have pricing power?
I mean, they have pricing power for the quality of the products, but I mean, Apple has been known to reduce the price of their product in certain markets. And I think there was some reports even last week that in China, there was some reduction in the price of iPhones. They've done this in other markets throughout the world. Why you don't necessarily see it crush their margins is you've had this mix shift over the years in terms of services, which has been a higher margin business for them. So they've been able to generate a very strong margin. Currencies are a hard thing to fight, though, right? This is a global company, so I think currencies are certainly something that are gonna have an impact also in terms of the guidance.
They can't do much about that. Walter, the top tier iPhone though, going on sale, that seems pretty rare to me. Are you saying that's not a big a deal as some people are making it?
I think it's a big deal because it's China, and China has been such a big part of the growth engine. You've seen it in other emerging markets in the past, which I think is maybe more understandable, but China has been able to grow without seeing these types of price cuts. So I think when we're all looking for kind of tea leaves on what's the impact of economic weakness, you can't ignore that as one of those things to watch. And maybe that's going to be indicative of how they look for growth or what their outlook is for growth for next quarter and the following quarter.
So there are all these knowns, right? We've heard from Qualcomm, we've heard from other chip providers that there has been diminishing demand for smartphones, for a number of other personal computing devices. How much is baked in terms of disappointment versus the unknown, right, of an even bigger slowdown than expected?
I think a lot of that is baked in, but remember, the iPhone is 50% of the revenue and even a greater percent of the profit of the company. And you have to look at what's going on in telco land right now, where they had a surge of growth during the pandemic in terms of number of customers signing up. And then there was a lull. And if they want to fight each other to grab customers, their willingness to subsidize, I think, could increase or sustain. Like Verizon, as an example, which is struggling to generate any type of subscriber growth, doesn't seem like they're going to give up in trying to give you $800 or $900 to get a new iPhone. And I think that's the data that we're seeing. So I think that's one of the offsets to a weaker customer and their ability to buy a very expensive iPhone is the willingness of wireless operators around the world, but particularly in these markets that are still huge for Apple and these high-paying markets, to subsidize that customer to upgrade their phone.
Which raises the question of how much the behemoths have an advantage in this environment. How much are you seeing a distinguishing factor of the haves and the have-nots within big tech as this earnings season grinds on?
I mean, that's a great point in terms of the people in society that are getting impacted. It's those that are buying iPhones might have a different impact than some of the layoffs that you're seeing getting announced by some of these major companies. But again, like if you have economic weakness globally and you're trying to sell a $1,200 product, you can't just ignore that that's going to have some impact. There will be some mitigating factors, like again, an operator willing to pay you to stay on their network or to switch over to your network. But that's still a pretty big headwind depending on how long this lasts.
Well, AT&T, we've got delayed bills in the mix. Walter, T-Mobile talked about the same thing as well. What do you make of that? What's the connection there?
I mean, first of all, I think AT&T was a couple of days. So to me, that was more, frankly, an excuse because they gave very bad free cash flow guidance earlier in the year. But you're right. T-Mobile tried to spin this yesterday. But the bottom line is, if you read through what the CEO Mike Seaver said, their billings, the payments there were also getting delayed. So yeah, I mean, you're seeing, and Walmart, obviously, you've seen evidence of, a weakening consumer. Again, it's just if you're weak and someone's willing to pay for your phone, maybe you're more willing to do it. The challenge here is what the operators want to get out of this is if they give you that free phone, they're expecting something back and they want you to upgrade to a higher end rate plan. And at some point, the consumer's not that they recognize what's happening and say, look, I don't want to pay an extra 10, 20 bucks a month on my rate plan. So even if you're going to give me $800 for a phone, it doesn't resonate. And I think we saw that with Verizon this quarter. They were willing to pay customers, for these phones, and they still didn't get people switching to their network. I don't understand why the company continues to do that, but at the moment, this is what these operators are saying, that they're willing to continue to try and subsidize and keep these customers.
Walter, just awesome, as always. Walter Piecyk there of Lightshed. Tom, that possible connection between what's going on with Verizon, AT&T, T-Mobile, and what might happen with Apple, something worth watching.
Yeah, it's a huge connect. There's no question about that. John, I would note the free cash flow build-out of Apple, modeled by Bloomberg Intelligence, is pre-pandemic $59 billion out to a ginormous $113 billion model for 23. Now, maybe that's going to get tweaked. I get it. This is a money juggernaut.
I'm so proud of you, Tom. When we first started doing this together, you knew nothing about football, and now it's all Liverpool.
It's emotional. I mean,
Mane, Salah.
Keene is 29 and holding.
And whether that works for Apple services, the iPhone.
Yeah,
it's just beautiful. From New York, this is Bloomberg.
It's embarrassing.
It looks to me as though the economy is doing fine now, but it's going to slow and inflation is going to slow significantly.
You have an inflation situation that, at least in our view, looks more persistent, looks more problematic.
All of these very high prices are just chipping away at the consumer.
The earnings estimates are still not reflecting an economic slowdown, so those definitely need to come down.
As to whether we are going into recession, what I would argue is, pretty surely we are doing so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. We stagger away from a Fed meeting and pivot to any number of stories. Earnings this afternoon, and inflation, it's going to disappear. John, don't tell Germany moments ago, an 8.5% statistic.
Brutal, Tom, and we're looking ahead for headline CPI in Europe too, which keeps the heat on an ECB and potentially pushes them to hike again into economic weakness. And it's the economic weakness here stateside that the Fed's got to do something about potentially, Tom, later this year, which is forcing some people to believe that maybe they back off from hiking interest rates much further.
They break it out in Germany, Bavaria up 8% year over year. Absolutely shocking. A shocking Fed meeting yesterday, John. We recalibrate into today and we stagger in this hour to an important GDP look.
8:30 Eastern Time. Recession on, recession off. Tom, it's not that binary. Are we seeing signs of weakness? Yes, we are. Will it bleed through the rest of the economy? Will it spread? Potentially. And that's what we've got to keep our eye on. I would say look out for jobless claims too. 3 straight weeks they've been ticking higher, Tom. Will it be week 4?
Stay with us here after the data check. Terry Weissman will join us here from Macquarie on said GDP. Lisa, also actually a very busy day, an important day for President Biden.
He's going to be talking with Xi Jinping of China. That's at 8:30 a.m. Interesting, it comes as the GDP numbers come out. And then at 2:15, he'll be talking about the economy. How much does he push forward a victory lap of sorts after getting together legislation that has been talked about for months, dealing with supporting the chip industry in the U.S. as well as, what did they call it? Fighting Inflation 2022 or something, the act of trying to
solid branding.
Well.
It's pretty
solid
good branding.
It is, especially because it used to be Build Back Better, and now it's, we're doing something about inflation.
We haven't talked about this. Did the credit space pivot off the Fed yesterday?
You saw the same rally that you saw in stocks. You saw credit spreads come in. I like what Peter Bukvar said of Bleakley Advisory. He put out a note saying, now in a pitch black room, hands out trying to find the walls. That's forward guidance at this point from the Federal Reserve. And I think that's the mood that a lot of people are in this morning.
Sounds like the Friday meeting of Bloomberg Surveillance to me. John, what did you observe off the Fed meeting, and particularly the conversation with Dr. Elarian?
In the eye of the beholder, it always is. And we always define the meeting by the intraday price action. And we often find out a couple of days later that was a mistake. They're highly data dependent. We've got 2 CPI prints, 2 payrolls prints, a Jackson Hole meeting, all before the next meeting. I've got no idea where we are when we get to September.
And the meeting to November as well. My data check starts with the 1-year trailing Dow, negative 8%, SPX, negative 9%, Nasdaq, okay, negative 18%. It's been an improvement there, John, to say the least.
We are off the lows. We're down 0.7% on the Nasdaq. Lisa's gone through the earnings for later. Apple and Amazon. The S&P down by by 1/3%. Yields in a couple of basis points, 276, 66. And that German CPI data, Tom, that's not going to help the cause in Europe at all. Eurozone CPI coming up, Tom, over the next few days. And we've got euro-dollar negative 0.8%.
Jane Foley just reiterating at Rabobank, maybe down to 0.95. Right now we jump to it. We're going to do a little bit of theory here. This is what you get wrong. It's like not in September. It's in October of your freshman year at any undergraduate course. You get down in flames on GDP and GDI. Thierry Weissman here with some careful analysis, global interest rate and currency strategist at Macquarie. I love the note. You go back to that dreaded thing, GDI. We all got in our brain GDP. You say forget about it. Look at GDI. What is gross domestic income?
Well, income generally is the receipts that the factors of production in an economy earn. It could be labor, it could be landlords, it could be companies, and by way of their profits, it could be savers in terms of the interest they collect on their accounts.
Mm-hmm.
What the factors of production earn is income. Now, in theory, income should be able to be equal to production. These are theoretically, in principle, the same thing. What you produce, you sell, and then you earn income. It's $1 for $1. But statistically speaking, and because of data issues and data processing issues, they're not always the same. Mm-hmm. And it turns out that in the first quarter, GDI actually rose, even though GDP fell. And Fed Governor Chris Waller made an important point to make that distinction, to say, look, even though we had GDP falling in the first quarter, we did not have GDI falling. And he concluded from that maybe the economy is not as bad as some people might think when they look at GDP.
This is really, really important, particularly as the president goes to comments on this afternoon. If GDI says we're not in recession, is that an elitist number? Is GDI skewed towards the haves because it's about big income of a few?
Not necessarily. It would only be that would only be the case if there's a problem with data collection, if there's a problem with sampling that skews the measure of GDI.
And you feel it's a legit number?
I do, but in other words, in the sense that the mistake that might be made or the discrepancy that's created in processing that data is not necessarily biased.
John, bring us down from 60,000 feet, John, please.
If we're seeing sufficient strength in the economy, Terry, if they are, what does that imply about how far they're willing to take interest rates?
Oh, it definitely implies that they're willing to take it higher. Remember that first of all, the NBER itself, which is the arbiter of whether we're in a recession or not, does like to look at income concepts as opposed to GDP concepts in deciding whether we're in a recession. So, if incomes are strong, it's going to make a stronger case for not calling a recession early. And it's the same thing with the Fed. If you look at the Fed, they like to look at broad concepts of economic activity and performance, and certainly incomes, including especially wage income, which is driven by employment, is one of those things.
How do you have any conviction whatsoever about rates or currencies, given that, as Peter Bukvar put it, they're in a dark room trying to feel the walls?
Yes, but I think the unique thing here is that every central bank is. And I think ultimately what's going to drive things like rates or FX is the relative growth concepts, especially FX, right? So Europe is also going into a slowdown, but if I can make a strong case for the idea that it's going into a bigger slowdown, a more significant slowdown than the US, then I can make a pretty strong case for the euro either staying near parity and potentially going below it. So I can not necessarily know how deep these recessions will be, but as long as I know that one country is going to have a deeper one than another, I can still make a call on things like foreign exchange.
What's the most important data that you're tracking over the next couple of weeks?
Well, it's interesting. You know, we've had about 13 tightening cycles in the U.S. Since the 1950s, and every single one of them coming out of the Fed has been associated with a PMI that has dropped below the 50 line, indicating a contraction. We're not there yet with the manufacturing PMI in the U.S., but we're going to get the July number in just a few days, and I suspect that it's going to be below 50. And if that happens, I think you're going to see more calls for the idea that we are entering a recession in Q3, but not Q1 and not Q2.
ISM next week. The ECB's in a dark room getting punched in the face, Terry. And I just wonder how much further they can take interest rate hikes. If you can identify sufficient strength in the US so you can't do it in Europe, what does that mean for an ECB facing the EM dilemma
So you and I spoke about this just a few days ago, right? Christine Lagarde said that they are watching the data, but she didn't say which data they're looking at. She didn't say if it was inflation or growth. I suspect that in the short term, it's still inflation. I don't think they can pivot that quickly. I think that inflation is going up in Europe, even though there are signs that it's stabilizing and potentially coming down in the U.S., because Europe has a problem with energy. Right? That's obvious to just about anyone. It's not just the cause of the inflation, it's also the cause of the slowdown. It's what's driving the sentiment indicators to the depths that we've seen. I think in the short term, she's still going to be more responsive to inflation than she is to the growth outlook. But maybe by the end of the current quarter or the end of the next quarter, Q4, there will be a pivot. I think it's more Q4 than Q3.
John, if we do our road trip to Melbourne, we have to take Terry with us. I mean, with Macquarie and their heritage.
How did we get from Frankfurt,
Sydney,
Germany,
Australia.
to Melbourne, Australia,
well,
and now to Sydney?
Macquarie is Australia's, wonderful bank. And so if we go to Melbourne
We're going to do a tour.
To do the road trip, we got to take Dr. Wiseman with us.
Okay, I'm happy to arrange that. When is this tour taking place?
I think in the deep summer of Australia. I'm thinking,
like January, February.
After Davos, come back, recuperate for a week, and then out we go.
Bramo can't wait. I'm not sure if Lisa signed up for this.
No, I don't know.
On a 24-hour flight with you and I.
Yeah,
Please keep talking.
Perth is too far.
It's going to be the
Harvey
cruise.
Weissman of Macquarie. Hey, the cruise I'm not touching.
I know.
You will not catch
we're
me on
not
a cruise.
doing a cruise.
You
No.
have
I
to
thought we were
pay
doing the
me
surveillance cruise.
serious
I've
money.
already signed
No.
up.
No Speedos.
I'll wave you off. I've got no interest in that.
Dot plot readings.
I've got no interest in that.
8 a.m.
At all. No. Okay.
Yield curve
This
inversion
CPI
look.
print, can I say thank you to Terry? I'm not sure I did that. Terry Weissman of Macquarie.
Terry,
thank you.
My pleasure.
This CPI print out of Germany is dreadful. 8.5%, the estimate 8.1. It's an early read. Tomorrow we get an early read on headline CPI core in the Eurozone, Tom. Looking for 8.7 up from 8.6, but I imagine there'll be some people re-efforting those forecasts over the next 12 hours.
To take the proxy, John, of maybe neutrality and trying to find restrictive, that gets you from, say, 8-9% inflation. How do you grind down to 7%, then from 7 down to whatever? And then, as Powell mentioned, time after time after time yesterday, their 2% mandate. To me, it's a three-part analysis. And what is absolutely stunning here is a timeline of that. Nobody has a clue.
The ECB is still at zero after a 50 basis point hike.
Well, yeah.
Could have a 9 handle tomorrow, Tom, on headline. Bramo, have you seen these numbers from Royal Caribbean?
So evidently, you're right. Nobody's going on a cruise, and you guys are not alone in that. Royal Caribbean coming out, their third quarter EPS is estimated at 5 cents to 25 cents. The estimate was 89 cents, and they expect a net loss in the second half of this
John,
year.
we could do a surveillance cruise like St. Petersburg to Miami.
It sounds like Royal Caribbean needs
do
it,
the
Tom.
show.
I'll still take a miss. Hard pass. No interest at all. No
Anything
interest
else?
at all. Can you imagine seeing the same people every day, every single day, and you're stuck on a boat? On a boat. You come on.
You sit by the pool.
You go on vacation to avoid people. You see the same people every day.
Look at those markets.
Look at those markets. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. A few minutes from now, President Joe Biden will speak with China's President Xi Jinping. Their phone call takes place at a time of increasing tensions between the two countries. China is unhappy that House Speaker Nancy Pelosi may visit Taiwan, which China considers part of its territory. There's a surprise agreement on Capitol Hill. Democratic Senator Joe Manchin struck a deal with Senate Majority Leader Chuck Schumer on a tax, energy and climate bill. It will enact major parts of President Joe Biden's agenda, such as a minimum corporate tax and allowing Medicare to negotiate drug price cuts. It also requires holding oil and gas lease sales in Alaska and the Gulf of Mexico, which could undercut the bill's clean energy focus. Jetblue has agreed to buy discount carrier Sprint Airlines, a price at least $3.8 billion in cash. The deal comes less than a day after Sprint ended a pending merger with Frontier because of a lack of shareholder support. The deal is likely to face a stringent review by antitrust enforcers in the Joe Biden administration. Meanwhile, Southwest Airlines reported second quarter profit that beat analysts' expectations. More people boarded the planes and ticket prices were higher, but Southwest is still grappling with high costs and delays in aircraft deliveries from Boeing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I think the catch-up phase and the phase of getting to neutral is over, and we're in a new phase. At some point, the committee will slow down, and that's a reasonable picture of how the next few meetings in the next few months will play out.
That was largely the interpretation of this market yesterday. That was Dennis Lockhart, the former Atlanta Fed president, from New York this morning. Good morning. TK Bramo and myself. Futures negative 1/3% on the S&P. On the Nasdaq 100, negative 0.7%. Been told off in the past for using nicknames, because what if someone new is watching or listening? Lisa Abramowicz, Tom Keene and Jonathan Ferro. Yields lower by a couple of basis points. You know, seriously, Germany Times have been told off that. It's ridiculous. 276.30, Tom, on a 10-year. Yields in 2 basis points. GDP, 12 minutes away.
You know, let's go into the nicknames here quickly before we get to the senator. John.
Let's do that. It's important, Tom.
John,
let's leave the senator from Louisiana waiting to go over this. What was it?
Was because I drank a chocolate beverage before Tang.
What was it?
Bosco. So you can say Bramo Bosco.
I'm not sure that's going to stick, Tom, in quite the same way.
Okay, well, let's see where we are. We've got GDP coming out here in 11 minutes, and a senator from Louisiana will pay attention to the economic might of the nation. He is Dr. Cassidy, and he is truly one of our most accomplished politicians. Whatever your politics, Bill Cassidy joins us from Louisiana now. Bill, I want to go back to your work with the senator from Arizona a number of years ago as you tried to hone benefits for the children of America. After the surprise announcement last night from Mr. Schumer and what the president will speak on today, tell us the common ground that you and Senator Sinema have on taxes and this piece of legislation.
Well, Sinema has been very skeptical of increasing taxes upon business when we might be entering into a recession. And I'm not sure entering recession is exactly the right time to create business uncertainty and investment uncertainty. That tends to prolong a recession. And so I can't speak for her, but I can imagine that those might be her thoughts.
I mean, the issue here of taxes, and just as one idea, and I know it is a GOP idea, which is we all understand the Internal Revenue Service is flat on its back. What is a Cassidy prescription to help the IRS bring in the fair share from all Americans?
Yeah, so the IRS has actually gotten, I don't know, $500 million for upgrading their technology, and yet somehow whenever they come before us, they say they need more money to upgrade their technology. So it's a little bit difficult to understand what the issue is. Now, of course, they say that if they could audit, if they have more money to audit high-income Americans, they could find those who are in tax shelters. CBO does not estimate the increase from that quite as generously as the Democratic Party does. So in a sense, that is something which has to be discovered.
Senator, the practical concerns that you're talking about whether more money will actually help increase revenues, but then there's the bigger picture issue with this inflation fighting bill, as they've been branding it. How much are you on board with what is proposed here in terms of supporting new renewable energies and trying to get some more energy independence in a way that could fortify against what we're seeing right now?
Yeah, so the bill came out last night at 10 p.m., 725-page bill. So I've not completely reviewed.
Completely.
Well, let's just look at some of it. It is going to increase tax credits for electric vehicles. Now, right now, that is a subsidy to the better off. It is taking money from those who are right now struggling, driving 15-year-old pickups, not because they choose to, but because they cannot afford to buy another, and it's transferring it to those who can afford to pay $70,000 for a brand new F-150 electric pickup truck. Now, that's kind of a reverse Robin Hood, taking from those who are less well off and transferring it to those who are more. When that's kind of a centerpiece of what they're billing, you're a little bit skeptical of the whole.
Senator, what's your proposal then in order to expedite some sort of transition to renewable energies as well as lower inflation from the supply side, which was some of the goals, certainly with the chip bill, but also certain aspects of this bill?
So you've gotten two things in there. What do we do about energy future transition? I've called for an Operation Warp Speed where we would actually begin to, just like we did with COVID vaccine, where instead of doing one thing, then another, always waiting for a previous agency to solve a problem, let's kind of line things up where you do things in parallel. Permitting is an incredible problem for renewable and for traditional energy. Until the federal government gets permitting more efficient,
right,
we're never going to get any of this accomplished. And that could shorten cost, it could shorten time in which to deploy. So one part of my Operation Warp Speed proposal is let's permit in a way which expedites as opposed to kills new projects, be they traditional or be they renewable.
Senator Cassidy, I've got 14 more questions from Matt Shirley down in Washington, but I've got to go to a Cassidy defense of Dr. Fauci, and I want to go to your liver expertise on COVID and the liver enzyme that comes out of this horrific disease of alanine aminotransferase. I want you to defend Dr. Fauci right now in the medicine that got us through this pandemic. What is the next step this nation needs to do given endemic COVID?
So endemic COVID is now endemic, it is not pandemic. And if you notice when President Biden, who's 78 years old and frankly appears a little frail, gets COVID after being vaccinated and boosted twice, he does pretty well, as best as we know. That tends now to be the thing. Historically, you start off with a pandemic which kills everybody, and no, not everybody, but many people, and then it decreases its pathogenicity. So I think we can expect this to become like seasonal flu and a little bit more. Get your vaccine, you've been previously immunized, you have a baseline of immunity, you do better.
What do you say to the critics of Dr. Fauci?
Well, Fauci got some things wrong. Let's just say it. Fauci said it would take 3 to 10 years in order to vaccinate. They were very delayed in admitting that previous exposure granted immunity. Until I remember I asked him point blank, did it do so? And he said yes. And I think the vaccine mandate for people who have been previously exposed and therefore somewhat immune was overbearing government. On the other hand, we have to just take a hats off to the NIH, which Fauci directed that division, for rapidly bringing that market to bear, working with the private sector in order to do it. And that's where I go back to Operation Warp Speed. It worked for vaccine, let's do it for energy.
Senator, I've got 10 seconds left because Tom took up all the time. Is that a yes or a no to that bill that Manchin's agreeing to?
Oh,
just
right
quickly.
Now, no.
You're a no. Thank you, Senator. Yeah. Appreciate it. Senator Bill Cassidy there on a range of things down in Washington, D.C. Futures down 1/3%. GDP, 4.5 minutes away in the United States of America. The range of estimates wide. Mike McKee's going to break down the details for you and why, over the last week, this has become very, very political. Your 10-year, 278.49, euro dollar, -0.75% for our audience worldwide. This is Bloomberg. We are 10 seconds away from GDP data in America, much anticipated over the last week. Equity futures going into it, -0.25%, just about on the S&P. On the Nasdaq, we're down 6 or 0.7%. Mike McKee in position, ready to break this one down for you. Mike McKee, a bit of data out, but not the one we're all waiting for.
Well, actually, John, we're just getting it now, and the second quarter GDP is a minus 0.9%. We're down 0.9% on the headline basis for GDP. Still looking for the breakdown. We'll get that to you in just a second. The initial jobless claims number comes in at 256,000, which is just slightly above the previous week. We have to caution that we're in this period now of auto plant retooling, shutdowns, things like that. Seasonally hard to adjust in the month of July, so we're not sure what that means yet, but it isn't overall good news. Okay, we're getting the breakdown now in terms of GDP, and we see personal consumption up 1%. It was up 1.8% in the first quarter. The GDP price index 8.7%, which is no surprise. That's a quarterly number. It's not going to be the number that the Fed is going to be watching. They'll be taking a look at tomorrow's number to find out whether we're making progress or not. The GDP drop reflects declines in private inventory investment, residential fixed investment, and federal government spending. Non-residential fixed investment down a bit, but the increase in exports we saw and the increase in personal consumption helped balance that out, but it is still a negative number, and until and unless we get a revised number, we're going to be looking at this as the second consecutive quarter of contraction, which is not a real definition for a recession, but it is going to be a hard thing for Janet Yellen in her news conference today to talk against. And of course, if you had Senator Cassidy on now instead of 5 minutes ago, he'd be crowing about how terrible.
I think he'd have some things to say.
Terrible
that's for
the
sure, Mike.
economy.
We've got to move
is.
at the front end. We're down 8 basis points on a 2-year, 292. I think you can all read between the lines here. There's a belief that we've got some weaker data. The Fed has to back away even more. The 10-year yield down by about 3 basis points as well. Equities were negative. They're much more so now. We're down 0.5% on the S&P. On the Nasdaq 100, we are down by 0.9%. Mike, you know what the rest of today is going to be like. Is this going to be a political debate or an economic one?
It's going to be a political debate. It could be an economic one to the extent that it tries to inform people, or people on Wall Street try to decide what it means for the Fed. But I don't think it means a whole lot in terms of the September meeting, because that's September 21st. We're a long way away from that, and much could change between now and then. But it is going to be a political debate, because obviously one party is going to accuse the other party of running the economy into the ground. And that's something that we are going to be debating. Non-residential fixed investment was down a 0.1%, so not a lot of decline, but it was up 10% the prior quarter. So business spending definitely pulled back. And one other number that everybody's been interested in is the difference between goods and services. Services spending up 4.1% for consumers, where goods spending down 4.4%. So we are seeing that shift that everybody expected into services, not enough to overcome the decline in overall goods spending, but it does explain why retail sales are weaker and spending is not as bad.
Mike, the illusion here for our listeners and viewers is disposable personal income up 6.6% with all that inflation, that oomph there, that money illusion, and real disposable personal income went down 0.5%. Which do fancy people like Jerome Powell look at? Do they look at our nominal illusion goosed by inflation, or do they look at a pretty grim real number?
Well, they're going to pay attention to the pretty grim real number because they're trying to get rid of the inflation part of it. But they're really going to be looking tomorrow when we get the breakdown in the ECI. That's much more important in the sense that it tells you where the money is coming from to people, which we don't see that often. Now, we don't have the breakdown for gross domestic income, but that's the thing that everybody's been wondering about. Is in the first quarter, it was up 1.8%. In the when we saw the decline overall in GDP. That'll come in the next release, so we've got to wait on that. But real final sales to domestic purchasers were down 0.3. They were up 2% the month before. That's kind of a good measure that people want to look at to take out the effects of inventories and trade. And in this case, it is not good news. It is a decline. So the economy clearly slowed in the second quarter.
You can see why the administration has spent the last week tying themselves in knots talking about it. Mike McKee, we'll hear from the president a little bit later. At the same time, 5 minutes ago, we understand that was the scheduled start time of a talk between President Xi and President Biden. Wonder if that's going to pop up on that call. Futures are negative, just 0.2%. We turn around now, again on the Nasdaq by just 1/3%. Equity markets bouncing back. I can tell you at the front end, not much has changed. We stay lower by 9 basis points on a 2-year at 291. It's the second consecutive quarterly contraction, Tom. Pair that with a 9 handle on CPI, and the optics are pretty brutal.
Yeah, I've got nominal GDP of 7.8%, just as a quick first look. John, we've got to talk quickly about the 2-year yield plunging into 2.91%.
Backing away, and it adds into the move we saw yesterday too. Shout out to TD, Tom. They had GDP at -1%, -0.9%. was the print.
Jonathan Pingle joins us now, chief U.S. economist at UBS, with a really concise note on all of this. Jonathan, do you look at this as gospel, or do you believe it will be amended in a second and third look?
Well, so gospel's a little strong. These numbers do revise. I think the key takeaway, though, is, Chair Powell tried to downplay this a little bit yesterday in his, post-meeting press conference, but going back to what Mike said, and we've been pointing out, for Q2, the guts of the report, just look weak. Real personal consumption expenditures rising 1% is soft. Coming into this year, we all thought the abundant household savings, pent-up demand, tailwinds would be more of a support. And to your point earlier, Tom, with prices eroding real incomes, the consumers just shaped up much more sluggishly than expected, and that I think is sort of the main takeaway from the Q2 GDP report.
Jonathan, this is stagflation all over. Basically, the idea that we're seeing inflation remaining high and going higher, with that GDP price component coming in at the hottest going back to 1981, at the same time that you're getting what some would call a technical recession of 2 straight quarters of negative growth. How much can the Fed really back away from their rate hiking, as the market has been believing, as what you're seeing in that 2-year yield coming in at a time when inflation is not showing signs of coming down all that quickly?
Yeah, no, I think it's very hard for the Fed to walk away. Yesterday was a really interesting meeting. Chair Powell came out swinging with tough talk against inflation right off the top in his prepared remarks, left the door open for another 75 basis point rate hike. But the broader message that seemed to get sent was that they were transitioning to a slower pace of rate hikes, which is fair. And this goes back, I caught the clip with Dennis Lockhart. They are moving on to this second stage now that they've brought policy to a kind of more neutral level. But inflation just remains too hot for them to think they're gonna stop. We're expecting a 50 basis point rate hike at the September meeting, and have been for some time. But there's just too much inflation in the pipeline for them really to relent yet.
Jonathan, with the greatest respect for economic historians, does it matter from your perspective whether the NBER calls this a recession or not? Shouldn't market participants just be trading on the data in front of us? And if it's weaker, it's weaker. And to Lisa's point, pair that with 9% inflation, it's problematic, isn't it?
Yeah, no, I think that's right. The NBER isn't gospel either, but the NBER does set a threshold for sort of how broad the weakness is. It hasn't shown up in payroll employment yet, and also a certain amount of the severity. Right now, as much as consumer spending's been weak, it is positive. We're just chugging along at pretty weak growth. Q1 in the report was held down by a lot of the noisy components coming off the very strong Q4. So, yeah, I would downplay a little bit the sort of the technical recession signal. But, going back to what Mike said, the fact of the matter is, and we've been sort of writing about, this is the problem with the Q2 report. Yep. The Q2 report's weak for domestic demand. It's the U.S. stuff that looks weak in Q2, and that doesn't really bode well looking ahead.
Jonathan, do you see this spreading to the labour market, and how quickly? Because one thing I think we'll hear from the administration later is that the consumer's holding up. They'll say things like the labour market is still strong. Do you see it remaining that way through the next quarter?
No, we have a pretty meaningful slowdown in payroll employment. We actually would make a case that it has been sort of artificially supported somewhat in recent months. You've seen substantially more weakening in initial claims, continuing claims, the household survey data. And given the severity of the slowdown in aggregate demand, we would certainly expect the labor market to follow. We're looking for payrolls to, at some point in the third quarter, run under 200K a month as part of that slowing, on the way to further slowing in Q4.
Do you wish you hadn't adjusted your forecast yesterday, given that it was pretty much on the money, John, before the upgrade yesterday?
John, bad form.
The optics of getting these inventory deflators correct and everything, we were pretty close in getting the decline. So and altogether, the components were sort of structured the way we expected. So I'm pretty happy.
He's giving you credit because the original estimate was basically on the money, John. Anyway, Jonathan, it's good to catch up. Jonathan Fingal there of UBS. We had a lot of upgrades yesterday based on the data of yesterday. Before we got those upgrades, some of them were very, very close to what we actually got. Tom, there we go, a second consecutive quarter of negative growth in America, and Mike McKee and I are going to break down those numbers for you again in the next hour.
I'm going to go away from the talk here. John, gross private domestic investment cratered. There's no other way to put it.
Subhadra Jaffa is going to join us from SocGen. She'll weigh in on all of this in just a moment on Bloomberg TV in about 20 minutes' time. Looking forward to it. Futures off the lows, we're down 0.25%. Yields come in 4 basis points on a 10-year, down 9 basis points on a 2-year.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. There's a deal that breaks the long deadlock on major parts of President Biden's economic agenda. Democratic Senator Joe Manchin and Senate Majority Leader Chuck Schumer have agreed on a tax, energy and climate bill. It calls for a 15% corporate minimum tax and would allow Medicare to negotiate drug price cuts. But Manchin blocked expanding the state and local tax deduction known as SALT. Now, U.S. Secretary of State Antony Blinken plans to speak with his Russian counterpart about a deal to free imprisoned basketball star Brittany Griner and another jailed American. Bloomberg has learned the U.S. would swap them for a Russian arms dealer it holds. The Kremlin says there's no deal yet. Confidence in the euro area economy has fallen to its lowest level in 17 months. Both consumers and businesses are haunted by fears of an energy shortage, and the ECB's first rate hike in more than a decade is feeding concerns that a recession is near. For the first time in at least 17 years, Comcast internet business added no new customers last quarter. That has shares falling today. Comcast also said that subscribers to the Peacock streaming service stayed relatively flat. The money-losing service had seen a surge earlier this year, and that was due to the Olympics. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The risk of doing too little are quite a bit greater than the risk of doing too much. And so the Federal Reserve is going to probably overdo it a little bit because they have to be sure that they're going to be successful in getting inflation back down to 2%. They'll just keep tightening for a bit longer. They'll get to a higher terminal rate.
Bill Dudley with us yesterday on a superb Fed show. Thanks to our team again for putting that together. The former president of the New York Fed, and it is a raging debate, and it is a debate off of the economic data we just saw. Help me, Lisa, the president with President Xi right now, and then he speaks when on the economy?
He speaks at 2:15, and that comes after Janet Yellen gives some remarks on the economy at 1:30 p.m. in Washington.
They are managing the message. It is a message of a negative statistic on GDP. Mike McKee and I were talking, folks, and the headline for me is basically investment in America disappeared. I'm sure that will be addressed in some form with the politics of the moment. Lisa, we've got a note. The tape goes up, red, now green on the screen, as we saw yesterday off the Fed meeting.
How much does bad news become good news again again, this sort of perverse dynamic where you start to see yields go down, price climb, and you certainly see that for the 2-year yield. How much does this really force the Fed to back away versus not in this stagflationary environment, Tom?
Right now, we're going to migrate here. We're going to pivot. That seems to be the word of the day, to one of the most inspired appointments as Commissioner of the Securities Exchange Commission. The Democrat Obama appointed Hester Pierce as commissioner for our Securities Commission. And of course, with so much going on, it's wonderful to talk to her, and particularly from her free market economics of the George Mason University. Hester, honored to have you with us today. The huge frustration I hear of people looking at a collapse of Bitcoin of 65% is, where is Gary Gensler and the SEC? Give us an update that you feel on the urgency of the SEC to intrude in the free market known as Bitcoin.
Well, Tom, it's great to be here, and I think that we can't determine whether to participate or not from a regulatory perspective based on price. But I will say that all the activity in the crypto markets of late has definitely focused regulatory minds in Washington. So maybe we'll get some regulatory clarity finally around crypto.
You and I studied Kenneth Rogoff of Harvard University, his book, The Curse of Cash. He said regulators any number of years ago get out front. We spoke recently to Professor Rogoff, and he was thunderstruck at how slow global regulation is. Why is there a tentativeness to address a currency down 65%?
Well, I think one of the reasons there's been tentativeness around crypto regulation is just it's difficult to figure out how it fits into our existing regulatory framework and whether we need to make changes. But I think there's also been in Washington a bit of a desire to see crypto just disappear. And I think people are realizing that that's not likely to happen. So maybe that will help people to think about where regulation is appropriate. But as you said, I mean, we have to bear in mind that people should be free to engage in transactions when both sides are willing to engage in that transaction. And so there needs to be a good reason for a regulator to step in the middle of that.
Right, balancing free trade, balancing freedom of financial innovation with the threat of fraud or the threat of some sort of financial instability. To that point, as you said, people hoping it's going to go away. It has not. In fact, it's become even more intertwined with the financial system in different aspects. How systemic has it become? And I don't mean from the actual just transactions of crypto assets, but the chip makers, the banks that have crypto trading arms. Do you have a sense of its clout in the financial footprint?
Well, Lisa, I still think that crypto is quite small. And so we have seen some problems in recent weeks, and I don't think those have flowed into the more traditional financial system. But I think they've been reminders that if you do things in the crypto world, like over leverage or overexpose yourself to a particular counterparty, you can really get into trouble, and those problems can be very severe. So it's a good lesson for people to have while crypto is still relatively small.
How different is it to offer up regulation or try to control certain markets in a constructive way at a time, I don't want to say control, to guide certain markets in a constructive way during a bull market versus what we're currently in a bear market?
Well, I think in some ways it's easier because people are more open to the idea that, hey, maybe we need to have better disclosures, maybe we need to have some rules of the road here. So I actually think it's easier, and it's been a good reminder to people that the number doesn't always go up.
Commissioner Pierce, help us here, and I'm going to touch on James Buchanan, the laureate of Year George Mason here, on the calculus of Robin Hood. A lot of us are worried that our children are on the couch with their laptops out, day trading because the trading is free. And yet all the adults tell us, well, no, the trading's not free. What does the SEC desire in this modern high-speed world of free trading?
Well, Tom, I have to say that, I can't speak for the SEC. I can only speak for myself. But I think retail traders in the United States have it better now than they have ever had it. And so whatever we do, we need to bear that in mind. We need to not change things for the worse for retail. And I think that there's real value to allowing people to choose among business models. And there's some people in Washington who would like there to be high commissions so that people wouldn't trade. But that seems sort of counterintuitive to me.
Commissioner Pierce, thank you so much for joining us. Hester Pierce is an SEC commissioner. Lisa, we've got to get to the news flow at hand and get to the president's important comments today. What I noticed there, and it's away from the themes that the president will talk about, business investment off a cliff.
And that's what we're seeing from different companies in their anecdotal reports, saying they're going to curtail spending on additional hiring plans. They're going to curtail spending on certain projects. You're seeing that from company to company, and now you're seeing that in the data. I mean, right now, the soup of uncertainty is making it very difficult. I don't see how people are viewing this as giving the Fed a green light to back away from rate hikes, which is how it's being treated in markets, Tom.
Massive curve dynamics since 2 p.m. yesterday. The 2-10 spread, the vanilla spread, was a negative 31 basis points, and we basically have that, Lisa, down to negative 17, negative 18 basis points. It's really dynamic now, that bet of linking what the Fed will do into our economic data.
Dynamic is one word, and Peter Pukvar put it another way, that we're all sort of in a dark room trying to feel for the walls, and that's what forward guidance right now is from the Federal Reserve. At a time when we are facing something we have not faced for 40 years, which seems like all of the contours of stagflation. How does the Fed respond, and how quickly does it take for inflation to come down? Tomorrow, ECI, the Employment Cost Index, may be the most important data point of the week, Tom, because it will give you a sense of how sticky it is when it comes to employment and the cost of hiring people.
And off those wages and benefits analysis of my favorite ECI, Goldman Sachs Publishing, I just glanced at the note. I don't have the numbers in front of me, but they look for a wage growth to really become quiescent here over the next 3, 4, and 5 quarters. I really want you to pay attention to Bloomberg on radio and television through the day. It is not as quiet summer Thursday, to say the least. All of this culminating with our analysis of Amazon, and particularly our Mark Gurman and his analysis of Apple Computer. We'll look for that after the 4 o'clock hour. Right now, a little bit of a lift to the equity markets. S&P futures flat, Dow futures at negative 20. Stay with us. This is Bloomberg.